a while, which is that, yeah, the recent data have been good, but they're not yet definitive. And I think they're very nervous about declaring victory and then having to undeclare victory. My guess is that that wouldn't happen. I think actually this disinflation is pretty deeply embedded now. But this is a Fed that really made a hash of things with the great transitory fiasco, and they can't afford to be wrong again, in the same cycle, in the same direction. That would look like they didn't learn from the first time round. So they need to maintain this optionality, and they need, I think, every couple of weeks they're going to keep reminding us until they stop that the inflation might come back and that they can't yet be sure, and that, yeah, we'll hike again if we have to. So markets took it badly because we've had such an enormous rally in stocks and bonds, but fundamentally I don't think he said anything very new. He's just reminding us that, yeah, there's still a chance that we might have to hike. I don't think they will, but he's not going to let go of it yet.
They're certainly not going to have a conversation about rate cuts anytime soon, Ian, based on what you just said. But ultimately, do you think there's reason to tolerate some kind of easing of financial conditions?
Yes, I do. I mean, I'm not at all concerned that the easing of financial conditions in the last couple of weeks is somehow dangerous or that it's going to spark any sort of resurgence in inflation, because I think the underlying disinflation forces are pretty deeply embedded now across the whole US economy, and in fact that applies in Europe and other places as well. So I'm not too worried about that, but maybe it just went a little bit too fast for some people at the Fed. There are still some hawks there, and of course Chair Powell has to juggle the views of a fairly wide spectrum of opinion across the FOMC. So he just wanted, I think, to dampen things down a little bit. And of course, they've said over and over again that they're not talking about cutting yet. Well, yeah, no one thinks they're going to be cutting yet. But the real question to me is what they're saying maybe in 3 or 4 months' time, if we get more good inflation data and more soft payroll numbers and more lower wage gains numbers, then, then the conversation will shift. But I think Chair Powell is very keen right now on not letting that conversation happen in a way that he would consider to be premature.
And maybe more messy bond auctions as well. Ian, let's talk about it. Michael Schell of Market Field Asset Management sat in this chair just across from me a couple of weeks back, and he talked about what was happening just in terms of supply coming to market and the way the bond market was responding to it. And he suggested, Ian, that maybe this Federal Reserve might have to move away from QT. Ian, what's your view on that now, given developments in the last 24 hours?
Yeah, I don't think we're quite at that point yet, but there's no question that the QT question is something that I'm hearing increasingly from people in markets. How much longer can they carry on taking 20 billion out every week, over $1 trillion a year at this steady pace when the funding requirement is still pretty big? And as you said, we've had messy auctions, and I'm assuming there'll be further messy auctions in our future. So far, the official line is that we're just going to keep doing the QT for the foreseeable future, but I'm not sure how long that can hold, and I wouldn't be at all surprised to see a change in the spring. But again, not yet. They're not prepared to make the change yet, as far as I can tell.
Well, do you get the sense that this is a liquidity issue, or do you get the sense that there is a profound uncertainty around the economic trajectory of a soft landing, a hard landing, or re-acceleration that we could see in the economy?
Oh, it's both. It's both. I've just spent the last couple of weeks talking to a large number of investors, large and small, private funds, hedge funds, banks, the whole sort of array. And the message I'm getting back from them is very clearly that there is still a huge spread of views. People are all across the spectrum. There's no consensus as to where we're going with growth and inflation. I'm talking to people who are adamant that inflation is dead forever, and others who are adamant it's coming back by tea time. So there's a lot of disagreement within markets, and that generates volatility, especially when you've got low liquidity. And I just don't see this going away. It's going to be with us for a while.
Ian, it seems like both Fed officials and market participants have been spooked by how wrong they've gotten the momentum that we've seen in the economy this year. Do you have an understanding of why people have gotten it so wrong?
Oh, well, this is the gazillion-dollar question for economists. I think there's a couple of things. Firstly, we all assumed that people would slow down the rate at which they were spending their savings that they built up during the pandemic. And so far, that just hasn't happened. It's carried on in pretty much a straight line. Now, whether it can carry on like that over the next year is a different question, because it now looks as though most of the remaining savings is in the hands of higher income households who probably won't spend it so quickly. But certainly up till right now, the third quarter, it's been pretty much a straight line run down. I don't think anyone expected that. And the second thing is, On the investment side of the economy, we've seen a huge surge in capital spending triggered by the CHIPS Act and the Inflation Reduction Act. Now that also looks like it's flattening off now, but non-residential business investment in structures, those chips factories mostly, 23% annualized rate in the first half of the year. That was astonishing. So these have been pleasant surprises, but playing it forward into the next 6 months, I think there's much less chance of seeing that story repeating.
With the San Francisco meetings coming up, Ian Shepardson, with Pantheon's focus on China, is the glass half economically full for President Xi in China? Does he have a legitimate 5% plus GDP economy?
No, he doesn't. And he isn't going to have that for the foreseeable future. The problems in the property sector are still extremely deep. We're now coming into starting our second year of deflation in PPI for manufactured goods. There's huge excess capacity there. They're not willing to do very large stimulus. They're sticking with this kind of targeted line and hoping they can kind of dampen the impact of the property catastrophe. And we've now got consumer deflation as well, mostly food prices, but nonetheless the signal there is of an economy where growth hasn't reached any sort of takeoff point. But it's unlikely to do that. The problems of China's economy run very deep, and they go way beyond just the business cycle. They've got demographic problems with a shrinking population, and of course they've got political problems as well, because President Xi is scaring away capital, he's scaring away innovators, he's scaring away inward investors, and all of these things at the margin are going to crimp and constrain China's economic growth for a very, very long time. So, returning to that sort of 5% plus story, you might get the occasional bounce, but it's going to be a big struggle.
Ian, thanks for the update. Appreciate it. Ian Shepardson of Pantheon Macroeconomics. Picture this. The year is 2023, and the world's largest bank is going around on a moped with a USB stick, settling treasury trades. Team coverage of ICBC up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening.
No, we're not going to do it. I'm so tempted to do it. All morning.
All morning.
All morning. I wish we could, but we can't. I wish we could even play it, but we can't. We could? We can't. Chairman Powell, of the Federal Reserve on monetary policy going forward from here. Let's turn to the price action. We look like this morning. Equities on the S&P 500 were negative by 0.1%. On the S&P, yields are higher in the bond market by 2 basis points on a 10-year. Nothing like the drama of yesterday, with a 30-year yield at one point yesterday higher by more than 20 basis points. Sloppy $24 billion 30-year auction. The jargon, it tailed in English. The supply came with a much higher yield than where the market was trading right before that trading deadline. And Lisa, ultimately, we priced with a much higher yield, something like 5 basis points that tail yesterday, which is just phenomenally high.
It's actually a record, according to some measurements, in terms of how much higher it traded immediately after the sale, which raises this question, why? Did people not show up? Was this some sort of hack that interrupted things? This is sort of what people pointed to. At the same time, a lot of people are saying it's all getting sloppy because people just don't have a compass of where the economy is going.
At all. Zero idea, and easily spooked, given what's taken place over the last month in this bond market. So your 30-year at the moment is higher, but only by 3 basis points. The 30-year yield at the moment, 4.79. Brammer was talking about this ICBC hack, Tom. So ICBC, world's largest bank, has had to send a USB stick around Manhattan to clear Treasury trades off the back of this hack, which is just crazy to try and get your head around.
I guess it could happen to anyone, and to give you an idea, their Wikipedia is one small paragraph. That's not the case for JP Morgan and other major banks, BNP Paribas. There's a mystery to this quote-unquote biggest bank in the world.
Well, it is a Chinese bank, and there is this question around whether Chinese banks have invested as much as U.S. banks in cybersecurity. We know that U.S. banks know they've been targets. They have much more complicated types of protective mechanisms. So here's the question. Does this mean that the ICBC was that much more susceptible, or is this a new level of susceptibility for the banking system to some of these hacks?
It's going to be interesting to see. And John, I think we've got to address this before we go to Jennifer Serrain. She's in London. This is not just a New York story.
It's a global story.
A joke of couriers running around Madison Avenue or Wall Street, whatever.
This is a global story. Banks have been worried about these issues for a long, long time, which is why they've been spending so much money, Tom, trying to prevent them from happening.
It's just been interesting to see. We could really spend the whole hour on this. We don't. We have precious minutes with Jennifer Serrain. She is in London reporting on this. And I really want to make clear, folks, this is an active reporting story for Bloomberg News. What is the response of London banks to this, Jennifer? What is the response of New York banks and indeed other state-owned enterprises in China?
Yeah, I mean, I think the entire industry really takes not just this incident, but every cyber incident pretty seriously. They've been investing billions in this space, and I think every bank CEO, if you get them, off to the side at a conference and ask them what keeps you up at night, almost every single one of them will say cyber, because it's something that they can spend billions on and still, fall susceptible to. So I think the entire industry is obviously watching very carefully how ICBC handles this, how it could impact markets. But really, the lesson here is this is a persistent and really scary risk for these banks.
Can I assume that the decision-making on this for this beleaguered large bank will be done in China, that all movements will be back to Beijing, Shanghai, and Hong Kong?
So they've made clear in statements that they've put out that this is only affecting this one U.S. unit and that it hasn't yet affected other divisions, but they are apparently reaching out back to their home office to make sure that this doesn't spread from here and really trying to make sure that the effects are limited and contained to where it's already hit.
Do we understand the mechanics of what actually gets getting interrupted here? That basically, my understanding is counterparties closed off their connections with the U.S. unit of ICBC in order not to get infected with the virus, which raises this question of how ICBC delivers and closes some of the transactions that it's gotten orders on. Is that kind of what is going on here?
Yeah, no, I think that's exactly right. And I think, it's interesting because that is generally the response we see from banks is as soon as they've identified a risk in the system, they try to close themselves off from that. And so that was why you saw a lot of folks yesterday during the Treasury auction kind of citing this incident as why it might have been so sloppy, as you guys said earlier.
Although it wouldn't affect the number of people, particularly those from China, that would be coming in to look to buy those treasuries, right? Ostensibly, those transactions would still at some point come to the fore, even if it's on a USB stick, going to another bank. Do we have a sense of whether this actually has prevented Chinese buyers from coming in and transacting in U.S. treasuries?
Yeah, I think there were a lot of market participants that pretty quickly hit back on the idea that this was the sole reason behind yesterday's, auction activity. And so I think we're still trying to get a sense of just, how exactly those trades will ultimately be handled. Does this actually end up, really fundamentally changing the way those trades are handled going forward? So I think we're still kind of in the information gathering stage on that one.
Do we have a sense, because my understanding is that the shutdowns or interruptions really began Wednesday evening, heading into Thursday's trading hours in New York. Do we have a sense of whether the volatility had been increased, or whether there was any strange activity affected in markets from a liquidity or purchasing standpoint ahead of that auction?
Yeah, I mean, I think there's been a lot of market participants kind of pointing fingers, and so it's hard to kind of nail down. It's sort of a chicken and an egg situation, if you will. Are people just pointing to this because they know it's a known entity out there, or is it some of the sentiment issues that we were talking about earlier?
Jennifer, who are these guys? Who is this bot? Who are these people? Do we have any clue, or is it just a complete mystery?
No, I think so. Our sources are telling us that this is the result of Lockbit, which is a pretty well-known criminal gang with ties to Russia. They were actually the ones that were behind the ion trading hack that happened earlier this year in the UK. And so, to your point earlier, this is definitely not a U.S. issue or a China issue. This is a global issue that every single financial services firms, be it banks, be it market makers, be it technology firms that just underpin these different markets, this is something that they're all really paying attention to and are all at risk of.
Jennifer, just to wrap things up, when things like this happen, are other companies, other clients nervous about doing business with the banks that are under siege in a moment like this?
I think certainly. I mean, I think there is something to the idea that you don't want to make a bad situation worse. And so we'll see how these banks kind of tread carefully today. But absolutely. I mean, a lot of these banks are, getting together every month in different DC forums and doing a lot of information sharing around the risks that they're seeing. But there's really not a good international standard setting body for that kind of activity. It's very much like country by country based. And so I'm sure that this will, call into question whether or not that needs to be a more global effort.
Jen, appreciate your time. As always, Jennifer Serrane there of Bloomberg out of London this morning on the latest, just this crazy story that's developed in the last 24 hours. The ICBC is basically under attack by what could be Lockbit, which is a criminal gang with ties to Russia. This is what is suspected of the attack at the moment, Tom, which has led them to struggle to settle trades and send around this USB stick around Manhattan.
Well, I get the
USB
USB stick. That's a theater right now, but I would defer to someone like Dan Tannenbaum, who I think has really got some experience here. And my question is, do the budgets that we spend, the millions of dollars we're spending on cyber, are we just holding meetings to hold meetings, or are we actually getting something done? To me, that's sort of the question this morning.
Well, you can get something done, but it's sort of this chicken and egg, this sort of game that you've got to play. You've got to advance faster than the perpetrators advance their technology to potentially hack you. I'm just thinking that, if I were advising some children who have any capacities whatsoever in cybersecurity, it might be a good industry to go into, because it doesn't seem like it's going
away. You're speaking to your kids?
I'm not speaking to anyone.
Are they tuned in this morning? That's what that's about.
Listen up.
If you're looking for something to blame that weak Treasury auction on, a lot of people feel inclined to blame it on this, Lisa. I think it's far too soon. We do not have the details before we can jump to that conclusion.
It's out there. This is because, come on. I mean, it's a bad Treasury auction.
We don't know.
Because, come on, our debt and deficit's out of control. We're spending $1 trillion on interest payments.
Okay, look, we have no clue, which is the reason why things have been bouncing around, because we don't know whether the economy is going to outperform or underperform. People completely got it wrong how much this economy would grow this year. It has spooked them because they completely did not get how much inflation was going to tick up. We've gotten so many things wrong. How can you have any conviction to know where we're going in terms of benchmark rates?
We've gotten things wrong all year. Like from week to week, the narrative's just changing, flipping back again.
And always wrong.
Do you remember we'd seen the highs, it was all over, then yesterday happened, everyone's like, oh no, it's back in the Treasury market, it's not gone away. Troy Eske's going to weigh in on this, of FS investments, that conversation coming up shortly. Going into the next hour, your equity market shaping up as follows. Here are the scores. Equity futures on the S&P, negative 0.06% on the S&P 500. Yields bleeding just a little bit higher, up a single basis point on a 10-year, 463.79 on a 30-year yield after a big move high yesterday. High by 2 basis points this morning. Your 30-year, 478 from New York City. Good morning.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
We're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything. CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer Wednesday on Bloomberg.
If you look at earnings, top line, growth of revenue, we've started to see some weakness there.
The equity market has become more expensive in absolute terms and more expensive relative to fixed income.
Markets are a little bit more volatile right now than the underlying economy is.
Ultimately, you will get to an earnings reset. We think that's part of next year's narrative.
I think that you have to look for opportunities and things that have struggled as you go into 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
The longest winning streak in 2 years is over. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market on the S&P totally unchanged. Down and down hard yesterday. TK, pick your poison. Do you want to blame Powell? Or do you want to blame that soft auction yesterday afternoon?
I'm going to blame Powell. That's where I'm going to go. But I think the auction was of value. And as I've said all morning, Bramo was right. I was wrong on the auction. But you know what, John? I'm going to blame Powell and the idea that he pulled back. But, you know, this morning I got a VIX, John, of 15.32. And we were 21 a worried cup of coffee ago. So, you know, even with a one-day pullback, it's remarkable where we are.
I'm going to blame the auction. I think, once again, spooking equity investors, developments in bond markets. Lisa, to see that yield move higher by more than 20 basis points following that auction speaks to how nervous people still are about fixed income.
And the lack of certainty around benchmark yields and where they're going to end up. I also think it's interesting, as you pointed out, bonds leading stocks once again. Stocks were kind of range bound and suddenly, boom, down 0.8% on the heels of the bond yields going up. Bond yields are in control, and that is unusual.
I do not agree that stocks are range bound. I think there's a lot of strategists really reassessing
yesterday
this. Yesterday, okay, fine, but this move, this 8-day, was it an 8-day move?
8-day winning streak.
8-day winning streak. The character of it was somehow different. I'll let the strategists explain it to me. I really want to know what John Golub thinks of this, you know, for an example over at UBS.
Inspired by a bond market movement, Tom. for yields to come
Yes,
from 5%
absolutely.
to a break of 450
Absolutely.
on a 10-year maturity, and then Lisa further out the curve to be spooked again at the long end. And we said at the start of the week that's where the test would be, not on the 3-year, further out along the curve on 10s and then 30s. And it was that 30-year auction yesterday that really got things going in the wrong direction for the equity market bulls.
And you could say it was Jay Powell, but he basically said the same thing. You could say it's because people aren't necessarily coming to market because of hacks or other things. Very unclear. We don't know anything about that. What this highlights again is what Mohamed El-Erian said on your show yesterday. The volatility is going to continue until we have more clear direction. I don't even understand what's going to give us that direction, because even Fed Chair Jay Powell is saying we could get this head fake. We've gotten a head fake before. Transitory might have been a head fake.
Well, as Mohammed said, the volatility continues even if the Fed is done. That's an important point. If you're just joining us, welcome to the program. Equities almost totally unchanged on the S&P 500. We snapped that 8-day winning streak on the S&P, the longest winning streak in about 2 years on the S&P 500. We did that yesterday. Day 9 would have been really rare. You'd have to go all the way back to 2004, and we just missed out. Yields are higher this morning by a single basis point. Lisa, the 10-year, 463.40.
We talk a lot about Fed speak. We do get Fed speak today. We also get ECB speak, 7:30 a.m. ECB President Christine Lagarde speaking at an event in London. She arguably has a harder story to tell with some of the declines in the economic momentum over there. Also at that time, we get Lori Logan of the Dallas Fed, and at 9 a.m. we get Raphael Bostic of the Atlanta Fed. Today, next week, we're really going to be focused on this, and this is kind of going to be laying the groundwork. It's day 2 of discussions between Treasury Secretary Janet Yellen and China Vice Premier He Lifeng in San Francisco. Biden and Xi Jinping are going to meet next week. Key issue for me, and I think that you touched on this well earlier, John, when you were saying, where is the balance of leverage? Is this going to be Xi Jinping trying to basically court the U.S. and some of those businesses to come back?
Data point, foreign direct investment, dreadful into China. The meeting I'm actually more interested in is the meeting between the Chinese leader and business leaders in America. Can they really calm things down, Tom, and send a consistent, predictable message out of China to allow that money to return?
After the photo op and the Chinese takeout in San Francisco, what's going to be that message? I'm lost. I don't know what the message is going to be.
How do you create certainty of policy at a time to try to get foreign direct investment to turn positive after turning negative for the first time on record?
I'd be more strident than that, sitting at the Mandarin Hotel in the Central District of Hong Kong. Can you give us back the Hong Kong we knew? And the answer is they have no interest at all.
In the meantime, how do people feel? And that's really what we're going to be watching. I feel great. I feel really glad that it's Friday.
Have you told the University of Michigan
how I feel?
How you feel?
I call them up. I say, hey, I have feelings. Please call me. I want to talk about my feelings. 10 a.m. People are going to be sharing their feelings. The University of Michigan Sentiment Survey. The question is whether it's going to be highlighting this frustration with how high the bills are at grocery stores. Also, the 5 to 10-year inflation projection, which doesn't matter until it does. If it ticks up and sort of coheres with this volatility we're seeing in bonds, maybe that will actually, spook markets more.
John, we got to get to Troy, but quickly here. They're out with rents and a rental change in New Jersey. Jersey City is as expensive as Manhattan. That's the new Miller-Samuel report.
I was just thinking about the small print in the press release that might come out later. We did accidentally call Lisa Abramowitz, which did skew the results negatively. Troy Gajewski joins us now, Chief Market Strategist at FS Investments. Troy, wonderful to have you with us on the program. Let's start with fixed income. Did we confuse a bond market rally for bond market stability?
Yeah, so, first of all, humility is in order for any forecaster right now. But so much of this cycle, whether it's rates or equities, is there's market price action, and then there's narratives that follow that price action. And, if you think of the way yields have gone higher this cycle, we've got to 3.25 for a picosecond, rallied back. Then we got to 4.25 for a nanosecond. And Tom, you really like this one. We got to 5 for a femtosecond and then rallied back hard because the positioning was so bearish. And so we came back down hard, and then the narrative builds that, we've reached the peak in yields. And then, of course, you either have a bad auction or you have Powell pushing back and, you have a 20 basis point gap higher.
The geek from MIT is 10 to the -9 this morning. Troy Gajewski, let's go to the reality. Get out the calendar. Everybody's got to catch up. I'm going to give credit to Goldman Sachs, a chart on how hedge funds were out of the market before an 8-day rally. You talk about the edge. You own the word alpha. How do we create alpha? Not the year end. How do I create alpha out to the summer of 24?
Well, so I think in a time like this, most of your positioning should be in what we refer to as Northwest Quadrant strategies, the efficient frontier, where you have lower vol, you're maturely accepting consistent returns. So, there's a few areas we've been focused on heavily. One would be prepayment sensitive RMBS, because given where yields are today, there's going to be incredibly low refi activity, really as far as the eye can see. So that's one area you're getting attractive carry. Spreads are relatively wide. We're not counting on spreads to tighten anytime soon until at least the Fed stops QT, which won't happen until a recession. But if there is a harder landing and they do QE, then obviously spreads are going to come in significantly. So you get income plus price appreciation. Another area, Tom, non-speculative on the direction of rates has been yield curve steepeners. Whether we get a bull steepener like we had earlier this year or a bear steepener more recently, we're fairly agnostic. And then for those that can tolerate less liquidity, when you think of this environment as a private lender, you have the bank stepping back, you have higher for longer, and these are all floating rate loans. So in what we refer to as a dare to dream scenario, where we keep rates high and we can avoid recession, you're going to have very attractive income, and you're not going to have the hangover of a recession. So those are three areas, Tom.
To translate the jargon frenzy you just heard, Gajewski's trying to capture the coupon right now. Troy, tell me about the equity markets and technology stocks. They have been on fire recently. Does the fire continue?
Well, when you look at an asset allocation, there's certainly no reason not to own growth, right? I mean, I never understand these arguments why you shouldn't own growth. You should own international, you should own Japan, you should own EM. I mean, this is a winner-take-all economy, both in the U.S. and globally. And unfortunately, or fortunately, depending upon how you look at it, that's really concentrated in the top 5-10 names in the S&P. So the issue we've had with big cap tech, particularly over the last several weeks, or mega cap tech, is are the valuations reasonable given realistic earnings going forward? Obviously, earnings are not going to be nearly as strong as they were the past 5-7 years. And we look at those multiples in the event of another round of multiple compression driven by Fed QT and money supply contraction, you're more than likely going to have some price declines. But as far as a secular holding, we don't know why you wouldn't have some in your portfolio. And then you look for other things to complement that in a very volatile market environment.
Can you give us a window, Troy, into the debates that you have at FS Investments about your year-ahead outlook for 2024?
Oh, yeah. So the debates are obviously a lot of fun. But, when you think of the economy, we've always been in the higher for longer camp. That being said, even we're surprised at how resilient the economy's been. What we're trying to fine tune, and we don't claim to have a crystal ball, of course, is what's the probability of recession in the next 12 to 18 months? Is it 50%, 60%? It's arguably higher than 40, probably no higher than 60. And what's the environment where the Fed can thread the needle? What's the probability of that, whether it's 40% or 30 or even 50? Because of the increased business fixed investment and construction spending, because state and local governments can spend, because the housing market at least isn't a dramatic drag on GDP. And then in turn, what does that mean for inflation forecasts? So, from a macro standpoint, it's trying with, again, humility to understand in which scenarios do certain trade expressions generate attractive returns, and in which other scenarios do you get better upside or better convexity, a phrase that I know Tom loves well.
Troy, given the range of potential outcomes, are longer-term treasuries virtually uninvestable unless yields are so high to compensate for all of those scenarios?
Well, so that gets back to the scenario analysis. We have cautioned everyone in fixed income that, again, every time market yields have popped up, just be aware before it's said and done, before we have that next recession, you could really get hammered with a bear steepener. And that's obviously what happened up until recently. You clearly have better risk-rewarded fixed income today than a year ago or 2 years ago. But until we have that recessionary outcome, or until at least markets truly price it in, not fictitiously price it in, but truly price it in, all you're going to earn is your yield, and you're going to have tremendous amounts of volatility. So we don't think it's time yet to extend duration cavalierly, but you more than likely want to think about that and understand that in a recessionary scenario, you don't have as much upside as you've had historically, because, where's the 10-year going to go? Front end goes to 3, 10-year goes to 3.25, 3.5. So you have upside, but not like the GFC or the Eurozone crisis or the pandemic or 2002. But if we stay in this dare to dream scenario and the Fed can thread the needle, you're going to get no price upside. You're going to have still a relatively low yield compared to when we had inflation this high in the past. And you could get some adverse market price action again. like we did yesterday.
A repeat of yesterday is not what many people want right now. Troy, thank you, sir. It's good to catch up, buddy, as always. Troy Gajewski of FS Investments, following a steep day of losses on the S&P 500 yesterday, following a big sell-off in the bond market once again. If you are just joining us, welcome to the program. The scores look like this. The S&P positive by just 0.01%. For once, the bond market unchanged, 462.41 on a 10-year. To Troy's point, the shape of the curve, Lisa, we've been talking about this. If you want to get long-end debt, long-dated debt away in this market at the moment, do you need a steeper curve?
Especially if you end up believing that the Fed is going to effectuate a soft landing. If that's the case, does that mean that yields are going to have to come down on the front end, that basically they're going to have to cut rates, not in response to pain, but proactively in response to lower inflation, and that you will get higher yields in the long end, but that those front end rates have to be pinned much lower than the 3 or 3.5% that Troy Gajewski was talking about?
This Federal Reserve, Tom, does not want that conversation right now, based on comments we had from Fed Chair Jay Powell just yesterday.
Yeah, well, okay, but he just set the meter record. I think he came out with his handlers and they said, okay, we've got to readjust the market. To me, what's important, John, is not the comment yesterday. I think we all sort of knew it was coming. What's the next comment? And particularly, what's the comment after next week's fireworks? CPI and retail sales.
Wait for the data.
Wait for the data, and
CPI
that comment's the one, in terms of an 8-day rally and the shock we've all been through, that's when it really matters.
Going through the research on the South Side on Wall Street at the moment, there just seems to be this consensus that the labour market is no longer a reason to be hawkish. Neil Dutta, Rem Mac has really led that effort.
Yes.
But with you, ultimately, the focus is going to go back to just CPI, Tom. What does it look like? Morgan Stanley think we get back. Get back, Tom. Get back to the twos. Okay, no big deal, no problem.
$76 West Texas Intermediate is distant from the inflation fears of weeks ago.
This hour, fantastic conversation coming up. Christian Horner, about 30 minutes away, of Oracle Red Bull Racing. That conversation coming up shortly from New York City. Good morning.
London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
I've made one of the toughest decisions of my life and decided that I will not be running for re-election to the United States Senate. But what I will be doing is traveling the country and speaking out to see if there is an interest in creating a movement to mobilize the middle.
Senator Joe Manchin of West Virginia announcing his retirement from the Senate in a video posted on X in the last 24 hours. TK, greeted by surprise. Are you surprised by this? I wasn't surprised by this at all.
I wasn't surprised by it all as an amateur, but I'm listening to the pro, Anne-Marie Horton, in the last hour, who made clear to me there was no surprise here, and that he was a significant number of points behind in polling against said Republicans in a very Republican state.
So what's the question, 2024 or 2028? Is that essentially what's going on? And then is this basically a Mitt Romney, Joe Manchin ticket? Because this has sort of been the speculation on the street for a little bit.
To those younger, show me a third-party effort that's worked. It's just from Perot on, it's just been a challenge. It's just a struggle in this system. I've got great respect, John, in the United Kingdom for the Liberal Democrats. I mean, at least, you know, I don't even know what the difference is between the three parties, but the answer is, hey, at least you got three parties.
I've never met a bigger fan of the UK system than you.
What's a Liberal Democrat? Where do they fit in?
Somewhere in between. Tom Keane.
In-betweening.
Somewhere in between.
Well, that's what Joe Manchin, seriously, that's what Joe Manchin's looking for. He's looking for the in-between.
It's something in between.
Yeah.
On certain issues.
The middle.
Let's get to the latest poll, shall we?
Please.
Bloomberg News Morning Consult. Swing state voters see US-Mexico border security as a greater priority than the foreign policy crises that are increasingly dominating the president's agenda. Here are the numbers. About 3 times as many voters, Tom, said immigration is their top issue in the 2024 presidential election.
We need perspective on this right now, folks. Wendy Benjaminson joins us with all sorts of poll experience. Wendy, just you're the right person at the right time here. When we go in the voting booth after Labor Day, after the October dash, when we go in the first Tuesday of November, what do we care about? To me, foreign policy never is what we care about. Am I right?
Absolutely right, Tom. Foreign policy never wins elections, but right now, the Biden administration is absolutely consumed with the Israel-Hamas war, as well as fighting with Congress to get more funding for Ukraine, while Republicans are saying, fine, but let's fund the border. Well, it turns out that voters in the swing states, the 7 swing states that Biden needs if he wants to win re-election, are saying, now, a majority of them did say, we want more funding for Israel and we want more funding for Ukraine, but 2/3 of them said, we want funding for the border and to secure the U.S.-Mexico border and to do something about immigration. So the administration is really going to have to, perhaps pivot and come up with a way to address those critical voters' concerns.
Wendy, I have the clearest memory of the celebration of the George H.W. Bush primary win and them dashing up the road at Killington, Vermont, certain they were going to win. The bandwagon was underway, and then it was the economy stupid. Is this going to be about the economy, or is this the culture war election?
I think it is going to be about the economy if the candidates listen to the voters. Now, while they did prioritize border security, 41% of these swing state voters say the economy is their top issue. And so if they focus on school boards and, other sort of culture war issues like that, it will lose. The one sort of issue that falls under the culture war umbrella that is clearly winning elections, as we saw earlier this week, is abortion rights. A majority of Americans want abortion rights, and the Republican Party lost a couple of elections this week because they focused on restricting abortion.
Wendy, do we have a sense of whether there are more swing voters than there have been in the past?
I think there probably are because, as my colleague Josh Green wrote this week along with Nancy Cook, nobody wants Biden and Trump. So, we call these the double hater voters. They don't want Biden to be on the ballot and they don't want Donald Trump to be on the ballot, which is why a guy like Robert F. Kennedy in our poll is gaining double-digit support. So, yes, I think, disenchanted, disillusioned, all those words are what describe the electorate right now, a year out.
Tom was saying earlier that typically independent running mates don't actually gain any traction in general elections, that the independent candidate for presidents have always just taken votes from one party or another. Is there a sense, Wendy, as Joe Manchin does his van life around the country, is there a sense that this time is different, that there is enough of a critical mass of swing voters that an independent candidate could actually gain traction?
I think that could be true because of the double haters I described. The trouble is that a guy like Joe Manchin, with a D behind his name and sort of the character he is, will tend to pull more votes from Joe Biden than he will from Donald Trump. That would damage Biden and probably split enough Democratic votes for Trump to win. Now, Robert F. Kennedy is more interesting because our poll showed that right now he is pulling equally from both Trump and Biden voters. So he, unlike Ross Perot, as Tom mentioned earlier, would be sort of a non-starter. But I think Manchin could have an effect if he decides to run for president. Right. And I think he might be too old. He would be 80 by the time 2028 arrived. So I don't think 2028 is in the cards. But he could. Turn it around for Trump.
Wendy Benjamin, tell me about the governor of Kentucky. To me, beneath the radar of the Tuesday elections was a 45-year-old, John, a 45-year-old in American politics.
Wow.
A mere infant. The infant from Kentucky. This guy has political heritage. Maybe he's a Democrat that climbs on board. What do they do with Bashar of Kentucky?
Well, he was extremely popular, and you're absolutely right. This is Mitch McConnell's state. A former coal state, very Republican, but it is a state that also has enshrined abortion rights after the Roe v. Wade was overturned by the Supreme Court. And Andy Beshear is a very popular Democratic governor, able to win in a red state. So Democrats might be looking at him in 2028 or 2032 or whatever, because he is, as you said, an infant in American politics these days. And, looks like he'll have a nice career ahead of him.
Wendy, thank you. Might last another 40, 50 years. Who knows? Wendy Benjaminson of Bloomberg, thank you. Appreciate your time down in Washington. Some amazing stats in this poll, Tom. Just to share a little bit more color on this. Gloomy signal for the current president. Swing state voters said they prefer his likely rival on key foreign policy issues. So poll respondents said they trusted Donald Trump to navigate the Israel-Hamas war more than Biden, 44 to 31, and preferred the former president more than the Russia-Ukraine war too, by an 11-point margin.
And it's not only swing states. To talk to our expert on this, Greg Giroux, folks, is just encyclopedic. Lisa, on the 5 Ohios, and Giroux blocks them out, and they're pretty much an equal part 5. And he says, look, you look at central Ohio, which is as purple as you get, and that's going to be the swing of the swing state.
One unique aspect of these two conflicts is how much they've split inside each party as well. And so I wonder how much that's informing some of the poll results, because Democrats are not in agreement if you go around and try to get some sort of sense of what people want to see happen, whether it's with the Hamas-Israel war or whether it's in Ukraine. Same among Republicans. So maybe it's just that there's enough of a critical mass of people who support the former President Trump at a time when everyone else is kind of splintering. I mean, really, this is such a unique moment in both parties in terms of lack of agreement.
I couldn't agree. The two fringes of each party. I think the Republican issue is around the Ukraine war here, Lisa, and then for the Democrats, they can't get consensus on how to support Israel at all, given the extreme fringe on the left side of that party.
And you could hear that from President Biden when he came out overnight and said Israel is running out of time, or this at least was how the New York Times reported it, that he said, Israel has a certain amount of headway before it expands the conflict and gets a lot of people angered and creates more hardline people on the other side. Is this because they actually think so, or is this because of the pressure internally to come out and try to end this more quickly?
Some of the latest numbers from our Bloomberg News Morning Consult poll, which came out in the last 24 hours. More on that still ahead in the next hour with Bloomberg's Anne-Marie. We'll catch up with AMH again in about 60 minutes' time. If you're just joining us, here's the price action. Equities positive by close to 0.1% on the S&P 500, trying to bounce back from yesterday's losses. In the bond market, a rally returns. We're down 2 basis points on a 10-year, 460.43. On the 2-year, yesterday, we had the first loss of the week, of the month, in the equity market. On the S&P 500, we had the first close on a 2-year above 5% of the month so far as well, Tom.
I went to cash late yesterday. Wait, no, I was already in cash, excuse me.
How's that working out?
It was good. Yeah, I missed the rally.
I'm sure.
Like big time.
From New York, good morning.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Attempting to end the week on a brighter note in the equity market. On the S&P, we're shaping up as follows. We look a little something like this. We're positive by 0.1%. We're actually down on the week on the S&P 500, even with that decent run, 8 days of gains going into Thursday. But yesterday's loss took us back below that line in the centre. Yeah, the Nasdaq just about unchanged on the session. Responsible for all of this is the bond market, of course. Just check it out, the 2-year, the 10-year, 30-year. The 10-year at the moment, back down by 2 or 3 basis points, 459.64. On a 30-year, we're down about 4 basis points to 471.97. It's the move yesterday at the long end of the curve, Lisa, that just spooked everybody. 30-year auction, really, really sloppy. Boom, yield surging higher again.
So the 2-year auction earlier this week, or was it 3-year auction? And then the 10-year auction.
If you don't know, I don't
I mean,
know.
honestly,
it was a 3-year.
It was a 3-year auction. I realized that I misspoke there. We're looking right now at a situation where meh auctions are raging successes and completely dreadful auctions, just plain bad, as some have been saying, are really disruptive to this feeling of stability that has been a fiction every time people try to coalesce around it.
The first thing I looked at this morning, Lisa, is in your world. I looked at the difference in yield between the 10-year and the 30-year, the 10s, 30s spread, and it didn't give me a lot of information. They're going up and down in tandem, right?
I think you're not getting a lot of information from the volatility at all. I think that that's actually perfectly said for all of the things that we're trying to rationalize and give narratives to this week, last week, the week before, etc.
You two agreed on something.
We agreed.
I'm in shock. Let's turn to foreign exchange.
This is Kathy Jones.
I can't believe it.
No
it's jarring.
We wouldn't do this for Liz Ann Saunders.
On the euro, 106.83. We're positive by 0.1%. Up until today, the dollar having a 4-day run. Dollar index stronger for 4 consecutive days, attempting to close out with the strongest week going back to July. Just trimming some of those gains at the moment on the euro, 106.83. Under surveillance this morning, the Industrial and Commercial Bank of China, the world's largest bank, launching a thorough investigation after being hacked in a ransomware attack. A criminal gang known as Lockbit with ties to Russia, suspected of orchestrating the attack, which forced the bank to send trades through a courier with a USB stick, Lisa, across Manhattan. Still trying to work out what's going on here, and ultimately, is there any connection between this and the story we were talking about in the bond market yesterday afternoon?
And how many computers can really accept USB cords to get the information, right? I mean, there are all of these real questions at a time when everyone's kind of mobile and it's all in the ether. This, to me, raises questions, A, about the security of banks, and this question around should we move to a more central clearing model for treasuries or something that is less bifurcated in all of these different entities. But the second question is, what does it say about everyone jumping to the conspiracy theory to explain a failed auction, not a failed auction, but a pretty poorly received one? That, to me, highlights the lack of certainty around what's really behind all the moves.
When you have to take comfort from a hack because you don't really know what's going on elsewhere, I think it speaks to how tricky the moment is.
Well said.
It's like, you know, you're in the market, please tell me it's the hack. that messed up the bond market and not something more sinister, which is kind of where we're at. West Virginia Senator Joe Manchin announcing he will not be seeking re-election when his term ends in January of 2025. In a statement, Manchin hinting a potential presidential run as a third-party candidate, saying, quote, "What I will be doing is traveling the country and speaking out to see if there is an interest in creating a movement to mobilize the middle and bring Americans, Tom, back together."
In a polarized America, we have to go back and understand most of his elections have been very close in a very Republican state. Back to the special election on the death of Robert Byrd, Senator Byrd of West Virginia, and that was, I believe, 53% he won. I mean, it is a state where he's going to look at a very tough election.
So there's a question about whether he's just avoiding losing the election or another close run.
I'll let Anne-Marie answer that.
Or this other, which is the implication there, or this question around, is he really looking into an independent bid, and is this time different, where an independent candidate could gain traction in a way that has not been possible over the recent decades? And that still remains a question.
Let's finish on this story. Treasury Secretary Janet Yellen wrapping up her two-day meeting with China's Vice Premier in San Francisco today. The meeting reported to be focusing on the increased use of security measures in commercial relations. It's happening ahead of the much-anticipated meeting between President Biden and Xi Jinping at next week's APEC summit. The two leaders expected to discuss foreign investment, tariffs, and greater transparency going forward. On foreign investment specifically, Lisa, I think that's a big topic of conversation for next week, particularly given the data we've seen more recently.
Yeah, in the past couple of days, the foreign direct investment declining into China for the first time in history. This, to me, really highlights the concern for Xi Jinping and possibly his motivation for coming here. But how does he give certainty? You asked this question last hour. How does he create certainty at a time where the rules have flipped and flopped and ideology has ruled over economic policy? It's going to be really difficult.
I go to John's point earlier. The body language of this American executive meeting with is going to be far more interesting. How can they get anything done? I mean, just as one example, China's bumping up boats against the Philippine Coast Guard in the South China Sea, or take it up north to the tensions of Taiwan. The idea that we're going to get substance here, or even the theater that we saw with President Trump on other visits, I just don't see it.
You know what corporate America wants, Tom? They want stable and predictable policies to make long-term investments. And in some parts of the world, they're not getting it. And let's see if we can provide some kind of soothing words to corporate America to provide it. I don't think we're going to get that in just a week. That's going to be an ongoing effort.
A headline from Morocco, John, just out. This I heard on stage in Marrakesh. Lagarde, if kept long enough, rates will take us to 2%. Is she singing from the Bundesbank hymnal?
Get back to 2% inflation.
Adamant.
That's the goal. How much damage you do in between to the European economy. The backdrop for European growth right now.
Right.
Very different to what we're seeing take place in America.
Will we get back to 2% yield? That'll be a great story. I believe that's price up and yield down, if I get it right. Kathy Jones now gives perspective, chief fixed income strategist in your kitchen this weekend, of what to do. She's with Charles Schwab. I am absolutely fascinated with an always open question to you and Liz Ann Saunders. What are people at Schwab doing with their fixed income money?
Yeah, so what we see among sort of the majority of the clients is they've been staying very short in duration. They're starting to move out. They're starting to get some confidence that they can move a little bit further out the curve. They're staying in high quality. Treasuries, very, very popular along with CDs, not really dipping their toes into low quality, but, you know, at these yields, muni bonds, investment-grade corporates, treasuries are looking attractive, and they're getting a little bit more confident about stretching out duration.
The pros are worried about liquidity, whatever that means in the bond market. Should our viewers and listeners be worried about liquidity and full faith and credit, simple-to-buy duration bonds?
You know, I don't think for the average investor, the liquidity issue is going to be a big one. I think for traders, I think for people like us navigating the markets for our clients, it's an issue. But I also don't think it's a critical issue right now in the market.
You are the one person who I was most looking forward to speaking to today. I really want to get your understanding of what happened with the failed auction yesterday, and whether you give any credence whatsoever to this idea that the hack of ICBC, of the U.S. unit of ICBC, had something to do with how poor it went off.
You know, I don't really know for sure. It is an open question because we haven't had something like this happen before. It seemed like the when issued market was okay
going into it. There were a lot of questions because we've had such a big rally at the long end, who would show up after rates dropped so much. So there's some questions about that. And then you start to get the Powell comments, and then you got the hack, whatever that may have had to do with it. So I think it's kind of a constellation of things. But we'd had such a big rally going into it after the 10-year went well and the 3-year went well. I think that had something to do with people stepping back.
What sort of signifies to you that we're actually getting stability in longer-term bond yields enough to get some conviction, to have some sort of trade that can last more than a couple days?
Yeah, we don't have it yet. Especially the further out the curve you go. You go beyond 10 years, you really don't have it. Even the 10-year, I mean, look at the volatility we've had recently, up 50 basis points, down 50 basis points. I don't think we're there yet. I think the market needs conviction that the Fed is really done and that the hold has some sort of time frame that you can anticipate. And then we start to get that stability. We thought we had it, and then Powell spoke, and we don't have it.
How much does this really have to do, though, with the Fed and its policy at a time when people are citing fiscal policy, or people are citing potential inflation, where people are citing just simply where are the buyers going to come from at a time of changing policy overseas?
Yeah, we haven't. So I tend to think it really has to do with three things that always influence the trend in rates. What the Fed is doing, because you have to discount that. There's no way you can get around the Fed, no matter how hard you try. What inflation is doing, which is tending to recede, and then how the economy is performing. And then you get into these other things like supply and who's buying, in China, Japan. But actually the foreign flows have been pretty steady, despite all this chatter. We've had the foreign flows hold pretty steady. The reserves are pretty steady. So I'm less worried about that. Fiscal policy, obviously it's a concern, but is it a concern today versus yesterday versus a week ago? That's a hard argument to make.
1 year out, am I clipping coupons, or can I actually invest for total return after a 3-year nightmare?
I think you can get some total return. It's not that hard when you've got a coupon this large to get a positive total return.
I'm going to clip the coupon, and I'm going to get some capital gain out 12 months.
I think 12 months from now, yeah. We have fair value, say, in 10s, right around 4, 4.25. And so if we get there, if we get even close to there, you're going to have a positive return.
Going into next week when we get CPI, how volatile is the market, and how potentially massive could some of the moves be on the heels of either an upside or downside surprise?
Yeah, I don't think we're done with the volatility, Lisa. I think it's here to stay for a while until we get either that, confidence about where the Fed is and where it's going, which I don't think the Fed really wants to give us too much confidence, right? I think they want to keep the market a little bit off center, or we start to get those labor market numbers that are just so soft that the market says, oh, okay, now the Fed really has to start easing.
Kathy Jones of Charles Schwab. Andrew Honhorst of Citi just published. He's had a hawkish view of this Federal Reserve through the whole cycle, much more hawkish than most of the street. And this is the kind of thing that he's writing now. Just listen to the shift in language here. The Fed is on hold. The bar to hike will likely not be surmounted even by the upcoming 3 months of stronger core inflation data they expect. Lisa, that's a massive, massive turnabout from Citi and Andrew Honhorst, who are basically saying this bar for another hike here is much higher than you think.
Given the fact that they were talking about another hike possibly this month, and that even then the momentum might be difficult for the Fed to take on, this raises this question: does that mean the long end yields are going to come down, or does that mean they could potentially go up further if the actual economic growth continues to be stronger than expected, and inflation does too, and the Fed remains on hold?
Goldman thinks that growth can continue. If you're just joining us, welcome. Equities right now just pushing a little bit higher on the S&P 500, up by 0.2%. Yields are a little bit lower by a couple of basis points, 459.83, anticipating the inflation data of next week. And Kathy, I'm with you, the labour market data. I've been asking this question all week, Kathy. I'd love your thoughts on it. The labour market data, the Federal Reserve seemingly, in the views of a lot of people on the street at the moment, no longer view labour market data as a reason to be hawkish. At what point, and you alluded to it, at what point is it a reason to be bearish on risk assets, given that it starts to suggest something a lot worse?
Yeah, I think I think we're kind of on the cusp of that possibility, because what you're seeing is real income growth slow down when you look at the labor market data. So we don't really know where Nehru is anymore. That used to be a really popular thing back in the day. And I think the Fed knows they don't know what that is. But if you start to see, you know, the unemployment rate rise, the hours worked continue to decline, the average hourly earnings continue to slow, you're talking about then income growth really starting to slow down significantly, and that's going to have the impact on the economy. I think that's kind of the constellation of numbers coming out of that that's really important.
Is this soft landing talk a moment or the destination? It's the moment right now, Bramo, and if you get to 4.5%, pushing 5% on unemployment, I think we might be having a different conversation, right?
Especially if you look at historical precedent, and an increase of 0.5 percentage point in unemployment over 6 months has never happened.
So it's
without
a journey?
more material.
It's a journey.
Close the door before you go on your journey.
Close the door. Close the door.
He just wants to curse on there.
Yeah,
he's
dying,
just, yeah, I know.
The more authentic me, if we were able to curse.
You going to Las Vegas?
I wish I was. It's cheaper to go to Vegas now.
It's cheaper to go than
hotel prices.
You and I looked at
ticket
road
prices
trip
to
and
F1.
it was ridiculous.
We can maybe go to F1. We're going to chat with Christian Horner, team principal of Oracle Red Bull Racing, as we anticipate a much anticipated race in Las Vegas. That conversation's next.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rate while this is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
The beautiful thing is that we have a lot of different Grand Prix still, and I think it would be very boring if they're all the same, right? And yes, I am very aware that we shouldn't go to all the, let's say, the commercial places, but I think also Las Vegas gives you a unique opportunity, and then time will tell, if it's the right way to go or not.
What a great season it's been for that guy right there. Absolutely dominant. Red Bull Racing's Max Verstappen speaking to us earlier in the summer, Tom. Looking forward to a race which is now just around the corner.
It's still there. And John, would you say that F1 is still large in moving off the huge success of Netflix?
Without a doubt. Big breakthrough. Yeah. Big breakthrough. Although there are some indications that maybe next week's race in Vegas wasn't as popular as they hoped for it to be, given some indication that ticket prices have come down, Tom. Hotel prices come down as well.
We're going to get to this conversation, John, quickly here. I loved Brazil. It was like an old course, up and down.
Classic
loved
track.
it, loved it.
I'm pleased you enjoyed that, Tom.
Let's do this right now, and this is going to be fascinating. A first time in Las Vegas, and what you need to know is in the vicinity of Tuesday, it will be 73 degrees in Las Vegas. That doesn't matter if you run a race at 10 p.m. at night Pacific time, 1 a.m. Eastern Time, 6 a.m. in the morning in Banbury, England, and the rest of it. Christian Horner is team principal and CEO of Oracle Red Bull Racing. And John, I'm sorry, it's about tires. That's what the experts tell us.
Christian, it could well be about tires. Good morning to you, sir, and thank you for being with us. I think we have to start by saying congratulations on an absolutely dominant season for you and the team. We'll spend some time talking about that in just a moment. Let's go where Tom went. Just approaching a new track you haven't had time with, you haven't raced on before, and with track temperatures that could be very, very low. Christian, what's the approach for you and the team going into an event like that one?
Take a jacket.
Is it that simple?
So, yeah, no, I was watching Max on the simulator yesterday driving around the circuit. It looks a great track. I mean, it's going to be super fast. There's going to be a lot of overtaking opportunities, and the tires, it could be like driving on ice. Which just adds another dimension. So particularly on a road course, on a street circuit, that can test the drivers and the team to the absolute maximum.
Christian, when it comes to stuff like qualifying then, how do you prepare to put that fast lap in that you try to do to get that quali in? How do you do that? What do you do? Set up with 3 laps before you go for the qualifying lap? What do you do?
Well, that's all going to come out of when we run on Friday for the first time. On Thursday for the first time, we're going to be learning, what it takes to get these Pirelli tires up to temperature, and is it going to be multiple laps in qualifying rather than a single lap? So it could be really interesting to see how that's going to play out. There's going to be a lot of data to look at, and the simulators are going to be working flat out on certainly Thursday evening.
Christian, any worries that this could just be a bit of a disaster, could end up in chaos?
Well, look, street races are always dramatic. We've seen that in Singapore, we've seen it in Azerbaijan, and of course Monte Carlo. And this one promises to be a big one. I think it's going to be one of the biggest viewed events in the sporting calendar this year. And so, I'm confident it's going to be a great success.
Christian Horner, I was appalled by the accident very early in the Brazil race. Your Perez was very much involved in that. How do you make the start of the races safer?
I don't think you can. I mean, you've got cars that will accelerate from 0 to 100 miles an hour in less than 2 seconds, and you've got 20 very competitive drivers all going, to try and make position into that first turn. So inevitably, sometimes there is going to be contact, but the safety of the cars, the safety of the circuits has increased dramatically, and thankfully we're seeing drivers walking away from what sometimes look like very nasty accidents.
Christian, you said 20 competitive drivers. Arguably there's 19, and then there's one guy on his own out in the front. I want to talk about that. The domination of Max Verstappen. He's still so young, Christian. He's taken over Alain Prost. He's basically on course to take over Vettel, maybe even in the next couple of races in terms of race wins. When you go back over the legends of this sport that you've been so close to over the years, Fangio, Senna, Schumacher, even more recently Hamilton, where does Max rank for you? What separates him from the rest?
Well, of course, it's always incredibly difficult to compare drivers from different generations, and but what I think is safe to say with what Max has achieved in a short period of time, with now 3 World Championships, 51 or 52 Grand Prix victories, it's an incredible record, and I think that he can now be spoken about in the same sentence, in the same category as some of the greatest drivers that the sport has ever seen.
How far do you think he can go, Christian?
Well, I think he's still so young. He's still evolving as a driver, and particularly as he gains more experience. So, and a lot depends on the equipment that we can give him. But I think he can achieve a lot more. He's motivated. He's hungry, and he just loves his racing. You can see that he's not interested in anything else other than just going racing.
He's been dominant. Your whole team has been absolutely dominant. I remember Ferrari being accused of making the sport boring in the Schumacher years. Do you take it as a compliment when you hear those kind of accusations thrown at your team?
Well, it means that we're doing our job, and that we're winning. But the one thing that's guaranteed in this sport is that nothing stands still. And I think with stable regulations, we can already see teams improving behind us. And I think that next year it's going to converge, and we're in for a much more tight championship next year, and also 25 before another reset with new regulations for 2026. So I'm expecting a much tougher year in 2024.
Right. Christian, to that point, and I have my Autosport at home. John Farrell made me get it. I try to read it and I try to understand it. A lot of your brethren are really trying to fix their cars now for next year. What do you do when you're as strong as you've been about tweaking the platform into the next season? Do you leave it alone? Do you leave the car the same as Verstappen is known this year? Or do you actually try to make improvements?
Well, you're always looking to improve because you can guarantee our competitors are going to be improving. They will be copying some of the philosophy, of our car. That's undoubted. We're already seeing that starting to happen, and we just got to keep trying to move the goalposts, to try and keep developing and improving ourselves. And so, of course, for the last few months, the factory have been very, very focused on that. But of course, you start to get into diminishing returns. And, it's going to be tough to improve the RB20 next year significantly from where RB19 has been this year.
Take us into the pit, because to some of us, I watch Netflix and I think I'm an expert. I'm not. Christian Horner, take us into the pit stop where you're 2.3 seconds, 2.8 seconds. How do you train for that excellence versus the other teams?
Well, it's the same as in any discipline. It's all about practice. It's about analysis. It's about the small incremental things, just where the driver stops. If he's 2 inches too long, then that will affect the timing of the stop. So it's rehearsal, it's practice, it's positioning the right people in the right roles, it's having the right attitude and the determination to continually improve and, of course, be consistent.
Christian, let's talk about next year. You've got 2 drivers, both under contract. There is a question mark over one of them, Checo. The drivers you have in the cars in the coming weekends, are they going to be the same 2 next year?
The only people who keep putting the question mark are you guys. I mean, people are pleasing that Checo's going to be our driver, next year, and he's had a tough 6 weeks, but he's started to refine his form. I thought the race that he drove in Sao Paulo was very strong. His race in Austin was strong, and he's finding his form again. He's second in the World Championship. He's over 30 points ahead of Lewis Hamilton with 2 races to go. So, let's see what he can do over these next couple of races, but he will be our driver alongside Max in 2024.
As a team, are you expecting Max to help him secure that second position, or does he have to do this on his own?
No, I don't think he'll need the help from Max, to be honest with you. I think he just needs to finish either ahead or just behind Lewis this weekend to secure that second position. I think we're treating these remaining races as cup finals, and that's how we've operated since winning the championship a few races ago in Qatar, and each race holds huge importance to us. And to race in Vegas, it's going to be a phenomenal thing, and we're going to be chasing our 20th victory of the year there for sure. And it's just very nice of them to have put a race on to celebrate my 50th birthday. I think particularly in Las Vegas.
Christian, you asked for it. Happy birthday. It's fantastic to catch up with you, sir. Congratulations on an absolutely dominant season. It's just been phenomenal to see play out all year. And thank you also, Christian, to you and the team for being a fantastic partner with this program over the last few months as well. Christian Horner there, Team Principal and CEO of Oracle Red Bull Racing. TK, absolutely dominant.
I wasn't into Las Vegas in at 10 p.m. Pacific time, 1 a.m. our time, with the danger of moving sideways on ice, as he said. This is not a normal race.
Because the tyres can't get the grip, yeah. It's going to be interesting to see. Returning to markets, equities right now, just about positive.
I'm part of the baby boomer generation, and this generation is now increasingly dealing with problems relating to Alzheimer's, dementia, and so forth. Not particularly my age, but maybe some people my age, even younger, but obviously in their late 70s, 80s, and 90s, more and more we're reading about Alzheimer's. Is this an epidemic that you can't really do anything about, or is it something we can deal with in some way?
It's a real challenge for a lot of families, mine included. I have a 90-year-old grandmother at home who's struggling with dementia, and providing care for her has been a real challenge. And for my family, we love her dearly. We want to be there for her, but it's painful for us to see the toll dementia has taken on her. This is rightfully, a concern for families across the country. We're investing a lot in studying dementia, to not just Alzheimer's, but other forms of dementia, to understand what's driving it. But very interestingly, there's also some research that's taking place, lifestyle research, if you will, on the impact of diet, of social connection, of physical activity, and sleep on dementia as well. Dean Ornish, professor at the University of California, San Francisco, has been actually one of the key folks, who has been leading some of that research on the impact of lifestyle and dementia. And this is a promising area.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Season is here.
Tons going on, lots of earnings.
Beat wherever you look.
Bloomberg breaks the numbers first.
It's a tale of two earnings. Results from Goldman Sachs, Bank of America, and Morgan Stanley.
Netflix is out, guys.
With exclusive expert analysis.
Recovery is underway.
They crushed it. It was one of their best quarters ever.
This is a story all about pricing power. We're going to make more money. We're going to make more money. And we're going to make more money.
You're making bank. And I think that is what we can take away.
Bloomberg Television and Radio. Context changes everything.
To be comfortable with the fact that if the market comes in 10 or 15%, that you're a buyer of the dips.
The quiet in the market is a reflection of stability in the multiple and stability in profits.
Given the setup into year end, we can expect some kind of Santa Claus rally.
It's going to be slower, but I don't think we're about to go into global recession.
The problem with soft landing and recession might look the same for a very short period of time.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Angst yesterday. Bramo out front in a 30-year auction. Forget about it. Futures up 9, green on the screen. I'm going to get a 14 print on the VIX. That was a one-day upset, John.
Are you saying that's a one-day upset?
I'm looking at the screen right now. That's what it says.
Repeat of that. We have to talk about that one-day upset. The 1-2 punch to sentiment in the last 24 hours. 1 p.m., sloppy auction. 2 p.m., Chairman Powell. Let's push Chairman Powell to one side and focus on that auction.
Yeah, he's behind the door.
This equity market rally of the previous 8 days, watch it, inspired by this move in the bond market. Yields down from 5% to a break of 450. Spooked yesterday by a long end auction. 30-year bond, Tom, coming to market, priced much, much higher in yield than where the market was trading. That spooked a lot of people.
Legitimate news yesterday. We had a hat trick of, not gloom, but a hat trick of angst out there. We've looked at the Bloomberg reporting on the Chinese bank. But Lisa, help me here. Which of these, the 30-year auction that you nailed or the Powell comments, moved the market? To me, it was the Powell comments.
Well, it was a confluence of events. It was an auction that made people feel uneasy about what the drivers were of of the volatility, of where the buyers were and at what price point. And then there was a Fed chair, Jay Powell, who came out with a different tone than people had expected, at least based on last week's press conference. Here's the issue, and I go back to what Kathy Jones is talking about. Volatility is here to stay. That's what she said, her words. If that's the case, what do stocks do? Is this sort of an acceptable level of volatility in treasuries where stocks can start to ignore them, or treasury is going to be whipsawing stock action for the foreseeable future?
I'm going to go to the foreseeable future of Wednesday. I'm sorry, it's a CPI report, more data, more retail sales. Next week, a dearth of economic data this week, John. Maybe had a lot to do with an 8-day love fest.
Add this to the calendar. Wednesday, November 15th, President Biden, President Xi, set to meet on the sidelines of the APEC summit, just confirmed in San Francisco. Key leaders who have not spoken, Tom, since the G20 summit of last year. On the agenda, AI, fentanyl, military communications, on the agenda for the President of the United States. Now, let's go back to our morning consult poll together with Bloomberg that we released in the last 24 hours on swing states in America for the 2024 election. Tom, just 1% said U.S.-China relations were their most important issue.
It's an
1% in our poll.
I completely take the point. I think Anne-Marie Horton has been wonderful on this. Wendy Benjaminson, I thought, gave perspective. It's domestic issues, and yet that poll confronts the geopolitics of the moment. And Lisa, it wasn't one thing like China. It's 5, 6, 7 things that are a November distraction.
Yeah, and there's a question of what crossover there is from national security to some of these other issues, right? I mean, there's a lot of intertwining of these issues when you talk about border security and other things. I will say, notable that President Biden is doubling down on the international, even as some of the polling is saying, hey, people are focused on the domestic more.
I'm going to get this in, John, on the data check because no one else is talking about it. 3-4 days in a row, even with U8 speaking, Euro-Yen tells me challenges on YCC in Japan. I'll be looking Sunday evening. You'll be out.
What am I doing? What am I doing? Come on. What am I doing Sunday evening?
You're going to be out socializing in Manhattan.
If you have a Bloomberg terminal, you can bio me on Sunday afternoon and you'll see a green dot. And you'll see a red dot next to you. No doubt about it. Equities on the S&P 500 look like this. On the S&P, we look like this. We're positive 0.2%.
Over.
Yields lower by a couple of basis points. 460, Tom. The rally's back. You can forget yesterday. That easy?
That was very good. I like that. I mean, we look at but oil, I've got to mention it quickly. Come on, $76 a barrel. That's an underpinning to the market of this talk of enduring disinflation.
Also, an associated fear as well, though, Tom. You get a break of 80 again on Brent. Get a break of 450 again on a 10-year. And we'll have that conversation about slower growth into next year.
The
the
ambiguities into the weekend. Senior Vice President Ambiguity at Merrill and Bank of America Private Bank, Joe Quinlan, joins us right now. Perfect voice to speak to as we recalibrate into the end of the year. Joe Quinlan, what are you doing in asset allocation? Let's start with cash. I've got it in a money market fund making 8%. Am I overcashed right now?
Not really, Tom. I just got back from the Midwest talking to a lot of our clients. They're happy to be in cash because they're worried about the election. They're worried about the geopolitics. But from our perspective, take the cash, but be ready to lean into equities. Get your shopping list ready to rebalance over the first half, maybe the first quarter of 2024. So cash is okay now, but long-term returns come from equities.
Which sector are you going to lean into? Let's start large. Is it growth or value that will drive us out 24 months?
Well, the sector specifics, really energy, healthcare. We still like technology. On any pullback, you have to own technology. It should be a core holding. We're long defense, cybersecurity, just the geopolitics, the reality of the world. So whether it's a mix of growth and value, but large cap leaders in these various sectors.
Joe, just on cybersecurity, that ICB story's got a ton of attention in the last day or so, sending a USB stick around Manhattan to clear Treasury trades after this attack by Lockbit, suspected to be Lockbit anyway, a criminal gang with ties to Russia. Joe, how much money has been spent on that area on Wall Street for financials and companies all across the country?
I mean, John, when you add it up, it's billions of dollars, the big banks. We got to move it into the regional banks, healthcare, you name it, hospitals. This is, unfortunately, it's a growth industry, cybersecurity. And it's something we don't talk about. You can see the images from the Middle East. It's right in front of us. But the cybersecurity, it's invisible, but it's very active and just as dangerous in terms of the overall level of economic activity. So That, unfortunately, is a growth industry as well across various sectors.
Are they the growth stories that you want to be attached to, though? The growth stories that are divorced from the cycle?
Any other growth stories? I mean, we like the hard assets. We like the infrastructure story. We've seen a little pullback, renewable spending, but I think, we're on the cusp of a kind of a manufacturing construction build out that's going to extend well into 25 and 26. So we're telling clients, these big industrial names, right? It's too early to go cyclical, the industrials, but on a pullback or any type of day where you can get a good company at a cheaper level of price, do it. And so that's what we're seeing here.
So, Joe, how much of your time do you spend talking to clients and saying exactly what you just said, that long-term returns come from equities, regardless of the day-to-day fluctuations in bonds? Just ignore that. It is becoming noise.
Lisa, quite a bit, because they're worried about the Middle East. They're worried about the election. I'm amazed how many clients want to talk about the election now. So we're going to be exhausted a year out. So we're having that conversation. But really, since 1945 to 2022, the annual average compound returns of the S&P 500 are over 11% because we got a great private sector. So I know everyone loves cash at 5% plus. But when you look at the long-term returns of U.S. equities, the S&P 500, it's double. So that's the point we keep pounding home to investors. So when you have these pullbacks, you step in and you buy quality.
The pullbacks have come on the heels of yields going higher. And this, I think, has been part of what's been spooking a lot of people is that, yes, those 11% compounded annual returns since 1945 came on the heels of a pretty massive bond market rally that fueled a lot of the gains, at least over the past 40 years. And suddenly we might be setting up for a very different scenario. Does that matter to you? How much do you say, ultimately, it doesn't matter because the private sector will remain strong?
A little bit of both. I mean, the private sector is going to be the private sector. But remember, Lisa, when we had zero interest rates, we had very low interest rates. We had a 10-year yield below 1%. That was the anomaly. We're going back to normalization. So if we get a 10-year yield at 4%, 4.5%, in that range, we get a 30-year mortgage rate back at, say, 6.5%. Like 6%, that's normalization. So we're normalizing at a healthier level, actually, in terms of cost of capital, which is going to help set the foundation for more growth, more earnings, more upside for U.S. equities.
Joe, you know the ballet. It's November, and I'm going to quote-unquote window dress out to the end of the year. Tell me about the Quinlan window dressing. How far behind on big tech is institutional Wall Street?
Many have missed it. We saw last year tech get crushed. So a lot of people, like I said, I'm not touching this. And so we saw them miss the rally and in general, not just tech, but in general. But I think people are realizing that a core holding for portfolios is technology, the digital economy, the cybersecurity risk, the AI revolution. You add it all up, everything leads to technology. And we, the United States, the big seven, whatever, and other companies, we're the leaders. So you want to have that as a core portfolio, a holding.
So US over the rest of the world for you, Joe?
Still, John, unfortunately, I mean, we're looking at flows coming in from overseas. Everyone wants to own the U.S. Everyone wants to come to the U.S. So it's still that type of world. And we don't want to be so U.S.-centric, but all roads when it comes to innovation, productivity, and leading global growth, it's the United States.
You're not lonely on that point, Joe. Thank you, sir. Joe Quinlan there of Maryland Bank of America Private Bank. The latest on the international front, I think China would like some of those flows. Let's put it that way. Getting confirmation just moments ago that Biden and Xi said to meet November 15th on the sidelines of the APEC summit. Lisa, the first conversation between the two leaders so far this year, widely anticipated, but simultaneously played down by this White House as it's going to deliver any kind of breakthrough anytime soon. I think a lot of people have their doubts.
Expectations are incredibly low, and yet people have been framing this as just having a discussion for the first time between these two leaders in at least a year is a good sign of softening ties. And I got to say, it comes at a time where there's a lot of speculation that China is behind an increasingly tight ring with Iran and Russia and China, all the names that are kind of put together around some of the geopolitics, that if there is a dialogue between Xi Jinping and President Biden, a lot of people are saying just that alone might be a good sign.
I wonder if it's a meeting of complexity or simplicity. I don't have a strong opinion on that. It'll be fascinating to see if they stay on first order niceties or they actually dig into details.
I could tell you what's on the agenda, according to the officials who brief reporters on condition of anonymity. On the agenda, the military realm, issues involving artificial intelligence, fentanyl, and detained Americans in China. The latest reporting here at Bloomberg. If you are just joining us, welcome to the program. Equities on the S&P 500 positive by 0.3%. Yields are a little bit lower by 3 basis points, 459.44. It's a quiet end to the week, potentially. Lisa, potentially going into the weekend.
I love watching pre-market trading activity and then just seeing how different it is at about 2 p.m. in the afternoon. It completely changes on a dime. It very well can, and it has. So to me, the conviction here really has to come from either long-term or else short-term following certain momentum. I mean, honestly, to me, it was so interesting. You have Kathy Jones saying that bond volatility is here to stay, and you have Joe Quinlan say, ignore it all, that basically just buy stocks, bonds are noise, and that stocks are going to keep doing well because that's what they've had for the past, 60 years.
And if in doubt, Tom, just blame the hack.
Yeah, well, the hack is there, and it's to me, it's going to be fascinating based on the Bloomberg reporting, and it's not just out of New York. John, get out the calendar. It is November 10, I believe a week from now, we're going to enjoy a government shutdown. No one's talking about it.
The 7-day countdown.
Normally, it's like I said, we need a countdown clock to the government shutdown, and usually this is the #1 topic. And now it's buried behind 7 stories.
Because we've had this story so many times, Tom.
Yeah.
Totally desensitized to it. But yeah, I'm with you. It's creeping up on us.
It's creeping up. The headlines out here, the Biden administration shutdown planning call was held on Thursday.
Was it?
Yeah, it's a conference call. There's
a good job.
400 people on it.
AMH is coming up next, so we can catch
She's
up
on the
with
call.
Anne-Marie. She's on the call, yeah.
Yeah.
Talking about what they can do, what they can get ready for ahead of that shutdown. She's not, just in case anyone ever believes some of the stuff TK's talking about. Equity futures on the S&P 500, positive here by 0.3%. Live from New York. Good morning.
Through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
These CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer Wednesday on Bloomberg.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
The United States has no desire to decouple from China. A full separation of our economies would be economically disastrous for both of our countries and for the world. We seek a healthy economic relationship with China that benefits both countries over time.
Treasury Secretary Janet Yellen speaking in a meeting with the Chinese Vice Premier in San Francisco. This is President Biden is set to meet with China's President Xi Jinping on November 15th. Tom, we don't want to decouple. We want to diversify. Decouple's become this word that no one wants to use anymore. Can't say that. I don't even think they want to say de-risk. They want to say things like diversify.
The language of all this, I'm going to go to Catherine Mann now over at the Bank of England and with Michael Rosenberg here at Bloomberg, really codified the dysfunction of the relationship. And the key phrase they use is not decouple, but our codependency. And maybe the question in San Francisco is, how much does China need our commercial business? To me, that, with the executives meeting, I mean, that's the backdrop.
We'll go back to the foreign direct investment stat, the data that came out more recently.
Stunning.
Negative.
Yeah.
So we've been talking about this charm offensive, that China ultimately officials need to go on a bit of a charm offensive here and to provide US leaders with some clarity. Because, Tom, if you're making a 10-year, 15-year investment in a country, you want some form of predictable visibility.
Yeah, we call that Hong Kong. And,
something stable.
I will always, speaking with Lord Patton, the day of the end of Hong Kong, he's in tears on in the interview, and it's just simple as that. Look at the facts and the observation that we've seen, and that's where you get this true bipartisan approach to this important meeting out of Washington.
It looks like both sides want to calm things down, too. Let's put it that way.
Yeah.
I'd be surprised if we got anything but that in the next week or so, but we'll see. We'll see.
We'll have to see. Joining us now, Anne-Marie Horton, our Bloomberg Washington correspondent. I guess we can tilt towards a meeting with China. Anne-Marie, to link it into the poll today, and I mentioned this earlier, but let's do it with China with this important meeting on the 15th. Does anybody really care about foreign policy, or is that the province of people like you?
Well, the President of the United States certainly does, and it means he has to use a lot of capital on it. I mean, these are things potentially are not top of mind for the American people, but the President is also dealing with issues that he necessarily didn't run on, issues that he has to deal with. Obviously, two massive conflicts happening right now in the world. Russia's invasion of Ukraine, what's going on in the conflict between Israel and Hamas. We should note, when you look at China, it is not just this concern about economics or potentially whether or not what the future holds for China, and are they going to invade Taiwan? But the fact of the matter is, the United States and China are on opposite ends of both of these conflicts. So you see a real power struggle right now. And I think that is why the global community, even if Americans aren't paying attention to it, leaders around the world want to see these two countries, even though Jonathan said earlier, there really is no deliverable, but they want to see the dialogue between President Joe Biden and Xi Jinping.
Emery, I believe the president of China will fly back and the government won't be shut down 2 days later. Is the president of the United States going to fly across the country to a November 17th shutdown?
Well, I guess that's why Xi Jinping has his central planning. Well, listen, President Biden should be back in time for this deadline. Remember, the government shuts down 12:01 a.m. Saturday, November 18th morning. So they have all of next week to figure out. Potentially, we're going to get a text before this weekend, or at least by before the end of the weekend is up, about what Speaker Mike Johnson plans to do when it comes to keeping the government open. Is it going to be a clean CR? He's floated potentially a CR, a continuing resolution, to keep the government funded till next January 15th or April 15th, or there's going to be this laddered approach, which some lawmakers I talked to are struggling to even understand what that means, but basically having multiple fiscal cliffs, keeping some agencies open and having different due dates. But we'll see how the Republicans plan in the House of Representatives to get this through. Speaker Johnson said he does not want to shut down, but remember, this is what cost Speaker Kevin McCarthy his job.
Anne-Marie, I want to stick on what we're looking at internationally with respect to the Xi Jinping-President Biden meeting. You were talking about how some of the conflicts, Ukraine, as well as the Hamas-Israel war, have heightened awareness of an increasing closeness with China and Russia and Iran. How realistic, how close are some of these ties becoming as these conflicts escalate?
Well, I think these ties are very close. I mean, look at the drones that Russia is using in Ukraine. These are Shahad drones coming from Iran. This is something that the administration wanted to put a lot of pressure to stop. China and Xi Jinping has a lot of power in these conflicts. He can really put his thumb on the scale and put some weight and pressure on President Putin and Iran to honestly hold back and to stop some of this. But China, for the most part, has said some of the right things in public, not all. Remember, it took them days. I don't even know if they fully come out and said it as explicitly to condemn Hamas's horrific massacre on October 7th. But China, of course, is getting a lot of cheap fossil fuels at the moment. Right now, they're getting tons of crude from Iran, and they're getting, basically, Russia, someone said to me, has become a penal colony for Xi Jinping and his fossil fuels. And they're hoarding all of these fossil fuels from Russia and Iran. So China has a lot of stakes in this, as does the United States. One thing we should look forward to in this meeting, which I'll be going and covering this. Remember, they haven't spoken since the last G20 in Bali. This time we're going to San Francisco. Is this military-to-military engagement. That was absolutely cut off when Speaker Nancy Pelosi made that trip to Taiwan in August of 2022. My question is, who is Lloyd Austin's counterpart at this moment? China has yet to name someone after Li Shangfu was ousted.
Do we have a sense, Anne-Marie, of how much the geopolitics really is going to dominate? Yes, there are these other issues at play, but how much some of these escalating conflicts and the tit-for-tat that you're talking about in the South Asia Sea really will be at the crux of what they're dealing with?
Well, I think it's going to be a slew of issues, right? Fentanyl is going to come up. I was looking at some of the fentanyl data and the deaths of the United States, and everyone, especially Republicans, have been pointing to China as this #1 influence when it comes to fentanyl in the United States. They have increased every year over the past decade, and I believe it was last year that it's the most we've seen, tripling the prior 3 years. So this is a huge concern, and that's showing up in our poll. Right? More Americans want to see aid to the U.S. southern border than, say, potentially aid going to Ukraine. So fentanyl, obviously economic coercion, the military-to-military engagement, and what is going on right now in these two power struggles in Ukraine and in Israel, these will definitely be top of the agenda.
Hey, Mesh, thank you. The latest down in Washington, D.C. with Anne-Marie on a meeting between the two leaders of the United States and China, respectively, next week. Let's sit on China. What wasn't for the Chinese economy this year? We were meant to have this reopening boom. It didn't happen. Take a look at the luxury players now, year to date. Richemont's getting hammered today. It's down by about 5 to 6% at the moment. It's off session lows, but ultimately, it's down double digits on the year to date. Earlier on in spring, we were talking about a boom for luxury, European luxury. LVMH is now up year to date, Tom, by 1 percentage point. We've basically wiped out all of the gains for the year on LVMH, TK. This luxury story has not materialized the way people thought it would in 2023.
And I take it broader. I mean, this has a China angle to it, clearly, but I would take it broader into retail sales that we see next week. It's 70% of the economy. We all know that statistic, but you know, I'm going to just drag luxury down to the broader middle class and even down to the basics of big box retailing. It's a mystery. That's all there is to it.
And it's more of a mystery in China than it is in the U.S., because in the U.S., the savings and the fiscal impulse has kept people spending at a pace that has surprised everyone. In China, the reluctance to spend, even when people have money, I think has surprised people. They have savings, but they don't want to spend it because there isn't the confidence in the economy in the same kind of way. And I think people have underestimated that to a significant degree.
And someone like China Beige Book would say it is about just that, their confidence in the only conduit they have, which is the property sector, separate, John, from what Richemont does on the Bund in Shanghai.
Yeah, Richemont's had a difficult quarter. Looking out. Softer demand for watches, Cartier.
You know, I'm at Cartier on a daily basis. I mean, they have Cartier. How's Cartier doing?
You were spotted coming out of a certain store.
They've got Cartier
with an orange bag, different brand.
Can I ask?
I've actually got the photo. You know, someone sent it to me.
Can I ask a stupid question? What is it with watches? I mean, the idea that somebody wants to wear $30,000 on their wrist as a status symbol.
As a status symbol, that's a very different conversation.
Yeah. So just having.
But if you're someone who really admires the workmanship, the craftsmanship that goes into something
like that. But that's why Swatch exists. I mean,
it.
I got a Swatch and it works. I mean, you know, that's all there is to it.
There's no way you've ever had a Swatch. Just no way.
From New York, this is Bloomberg.
That's me, Max. What's up? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Bloomberg surveillance off of the tragedy of yesterday. We look at futures up 13, Dow futures up 106, VIX threatening a 14 level. We go to Lisa Abramowitz for team coverage here. What happened to the gloom yesterday, Lisa?
Well, you know, blinking, maybe it'll come back. I mean, this is basically the issue, is that people are trying to fumble around different levels. I keep going back to Joe Quinlan saying it's getting kind of exhausting, just ignore it and just stick with stocks. And how many people are going to coalesce around that?
Or is it just the good feeling of that banner that we just talked to Anne-Marie Horton about? The President of the United States will meet with the President of China. That's germane to me.
So you think that that's giving people confidence to go into risk assets?
It takes the fear, it takes one level of fear away. I'm not saying it's confidence, that's overselling it, but it's a good tape this morning as well. Jonathan Farrow in preparation for, I don't know, what's the show? He's doing the real yield? Or
he's doing like, the open.
He's working all afternoon, I think. We got Dana Peterson coming up here. Again, the future's up 12. But right now, and this is important, down at the, in honor of Ken Rogoff, the Jacques Polak annual research conference at the IMF, Michael McKee was holding the door for Jerome Powell yesterday.
We're not going to go there.
off
we have all morning, Mike.
In your years and years of doing this, and Mike, you know, we're not going to go through the litany of Michael McKee's stories. It's the biggest risk for all these people, that dreaded off.
Oh, well, everybody in public life, you know, it goes through that at one point or another, and you want to make sure you don't say it. The most famous of all was Ronald Reagan when he was joking around and said, "We begin bombing in 5 minutes," and that went out over a live mic, and that caused some consternation around the world.
Let's talk about the consternation we saw yesterday in our data dependency to next week's inflation report. Does next week's inflation report cure all if it shows a disinflationary tendency?
It probably makes things a little less volatile for a while, put it that way. It's kind of hard to know, with everything going on in the world, where you want to end up. And I noticed that several bond market strategists are saying the one thing you don't want is to go long into the weekend, because nobody knows what will happen over the weekend. Basically, Powell tried to push back to where he was the day before the Fed meeting, or right after the Fed statement came out, when everybody was taking that as relatively hawkish, and then his press conference, as so often happens, turned out to be more dovish for people, and they started pricing in rate cuts. Whether he is going to be effective at holding that, it's hard to say when you look at where the bond yields are today.
Okay, we joke all the time, but in reality, how often do Fed officials look at the bond market and then calibrate their discussion points around what they see there?
Well, very rarely. As long as trades aren't failing, they realize that markets go up and markets go down, and there isn't always logic to what's happening. And so they're not going to get overly concerned. They look at the Fed funds futures, and they know those can change on a dime. By next Wednesday at 8:30 in the morning, we get CPI, and then, you know, who knows where yields could be. So as the Fed looks at this stuff, it's like we can't control that. We can't do anything about it.
We were talking about Andrew Hollenhorst of Citigroup coming out earlier today, and he was one of the people saying earlier this year he expected the Fed to hike one more time. Now he's not, and now he's saying that the bar to hike again is infinitely high at a time when we do see signs of a slowdown, particularly in the employment data. Do you agree with that? Do you think, all things being equal, the Fed is essentially done unless something catastrophic happens or incredible, and that they are more willing to cut rates?
No. That last phrase there would be where I would disagree. I think the idea of infinite is not necessarily true. I think the bar is higher for another rate increase, but it is not as high as the bar for a rate cut at this point. The Fed accepts the idea that as interest rates stay high and inflation goes down, in theory, if inflation goes down, that real rates rise, and they may want to back off a little bit to keep essentially the same amount of tightness in the markets, but they don't know when that's going to happen because they do anticipate, and I think Jay Powell said this yesterday, that the last percentage point from 3 to 2 is going to be really hard, and therefore they need to keep the pressure on. So they're not going to put any kind of date on it at this point, and they don't want the markets doing that, so they're staying away from the rate cut part.
One quick question in the zeitgeist this weekend is the Somm rule. This is Claudia Somm, who's been an immense supporter of what we've done. She's trying to game recession. She's been extremely clear about what her data says within her equation. Are we anywhere near a recession based on the Somm rule or any other key measurement?
Not based on the Somm rule at this point. If unemployment continues to go up, you could see that. But right now, as she points out, you have to go basically 50 basis points higher, and we're only 30 basis points higher. So you've got some room between now and then. And she also thinks because this has been such an unusual recovery that maybe the rule won't apply this time.
Got you. Change the rules as you look at the rule.
Change the rules, yes.
Sounds like English Premier League soccer. Michael McKee, thank you so much. With a brief into an important week next week on inflation and on retail sales. And for that, a brief, wonderfully positioned, I'll say, at the conference board, their chief economist, Dana Peterson. Dana, how is consumer America? How are we into the retail sales report next week?
Well, the interesting thing is that consumers continue to complain about life. They're very concerned about inflation, particularly high food and energy prices. They're saying that interest rates are too high. It's impacting their ability to buy homes. And they're also more concerned about geopolitics and the state of Washington. So with all of that, consumers are saying they're concerned about their future finances and incomes and even job availability.
I love that we're going to have a segment about feelings ahead of the feelings survey that we get out, the University of Michigan sentiment survey that we get out at 10 a.m. How closely related are people's feelings with their doings, with what they actually are buying?
Well, the interesting thing is that when we look at current conditions, consumers are still purchasing things, but they're putting it on their credit cards. Just earlier this week, we received data from the New York Fed that shows that credit card use is still up, it's rising, and also so are delinquencies. And delinquencies for credit cards, auto loans, and even other loans are now slightly above the 2019 level. So consumers have run out of that excess savings, especially at the lower end of the income spectrum, and they're shifting to very expensive debt to finance their purchases.
Is there some correlation historically between a downturn in sentiment and a recession and the labor market and some of these other indicators that are more closely followed by people at the Fed and beyond?
Well, if you look at the Consumer Confidence Index, it almost never tells you what's going to happen with consumption in the GDP NIPA data, but it does give you a sense of how consumers are feeling. And if they start worrying about the future, especially jobs and business conditions, it oftentimes presages something negative. Now, we do have a new indicator in our consumer confidence survey, and we asked them outright, do you expect a recession at some point over the next 12 months? Now, those expectations have eased, but it's still 69% of consumers say that there is going to be a recession.
Well, let me go right there, Dana. I think that's really, really valid. In all the work you did, all the economic history you did at Wesleyan, which leads on economic history, is there any ability to pick and call a recession?
Well, we do have our leading indicator, and it's usually pretty good at signaling recessions. Now, it's been negative for 18 months, and it's been signaling recession for quite some time. But the thing is that it doesn't have much in the way of services, and we know services spending has been very strong, and that's a product of the shifting in demand post-pandemic, less on goods, more on services. And so it may not be telling the entire story. So we're definitely watching other measures of services.
Absolutely brilliant. And the basic idea here, folks, and this is important, and a question to Dana Peterson, is that, okay, if it's a services America, and it's a kind of services America which we really don't understand it, can we actually utilize Friedman from, come on, Dana, Friedman could be your great-grandfather. Can we utilize Friedman from 1950, whatever, on long invariable lags? Can we actually have that conceit?
Well, I think long and variable lags are very relevant. When we look at monetary policy, it hits the economy at different points in time. So higher interest rates have definitely subdued the housing market. And I think when we look at the GDP data from the third quarter, businesses are getting bitten by the higher cost of capital. Now, the next thing is consumers. And certainly in our survey, as I said, they are complaining about higher interest rates. And certainly that's going to start affecting consumers when they have to start paying those elevated credit bills at those very high interest rates.
How political are people's feelings?
Well, we don't ask them like, how do you feel, politically, but we do ask them what they're worried about. And more of them are saying they're concerned about geopolitics and also what's going on in Washington. But we really should look to what happens in elections to get a good sense of how consumers feel. And we just had one this past week.
Well, the reason why I ask this is because there have been a number of surveys showing big divides in the sentiment among different voters based on specific issues and how they're being portrayed in certain circles. I'm just wondering whether that's become a more polarizing factor in some of these sentiment surveys in recent years, or whether it's always been that way.
Well, when you look at one of our competitors, they actually do ask people about how they feel by political party. And it's usually the case that whatever party's in power, those folks usually feel better than the other party if they're depending upon their political affiliation. So it's not really a great measure, because if your guy's in the White House, then you feel good about it.
Dana, thank you so much. Dana Peterson, terrific brief there on the data that we look for next week. She is with the conference board. I think things are so topsy-turvy right now, and I mentioned this. We're 7 days out from a government shutdown. Nobody cares. I don't care what Anne-Marie Horton says. And the idea that, yeah, we have huge data next week, and nobody's really talking about it.
I love that you say that Anne-Marie was trying to make us care about the government shutdown, when you basically were trying to make her care about it and give us some information about it, because we don't really pay attention to it.
OMG, we're gonna shut down.
Well, exactly. And the reason why people aren't paying attention is because it seems to happen every other month. But you're right. I think the CPI data is going to be a really big deal, and the retail sales, especially because of the volatility and the lack of certainty around the trajectory going forward. To me, the amount of jumpiness that you get in bond yields and then commensurately in risk assets is just keeping everybody a little bit on their toes.
I think we've had a dearth, I'm going to say, of holiday shopping microanalysis. Not that I've ever paid much attention to it. Dow up 114 points. Market's surging here. It's a Brahmo rally. The VIX 15.02, trying to give us a 14 print. Speaking of 14, the S&P up 14 points. Standard & Poor's 500 up 0.3%.
When you talk about the holiday shopping season, do you shop right before Thanksgiving? Is that your thing? Have you ever waited in line before a store before a store opens on the morning after Thanksgiving?
Here's the history. In the old days of a more graceful Wall Street, you would work Christmas Eve, take somebody to lunch or late breakfast, whatever, Christmas Eve, and then you'd begin your shopping. You'd begin your shopping 11 p.m.,
Christmas
11
Eve.
a.m. Christmas Eve, you just go in and find something for someone, not a lot of planning.
Is that the Tom Keene prescription, or the more graceful prescription?
I think a lot of people used to do that before this retail madness that we all invented.
Why is it that we're here today? Because there are a lot of places that are shut down the day before Veterans Day. And I'm trying to understand what the bond market holidays and the stock market holidays.
I had the honor of giving a speech at the New York Stock Exchange about this. The oddities of when we trade stocks is comical. Like, we're off Good Friday, but we're not off choose your major Jewish holiday, and I find that just completely non-modern. I think that's almost from the 19th century, and you have it here with Veterans Day, which for the people that served, I did not, but for the people that served, I'm sorry, this is an important day to remember World War I.
And there will be a moment of silence, I believe, at 9:20.
Yeah.
I believe later on this morning, in honor of Veterans Day.
Right.
It is an important holiday. It just, to me, the sort of confusion around what is.
Well, there's 35 days left in the year, and I've got 40 days of vacation, so see ya. That's what
the second time you said see ya in 2 days.
Coming up, my last interview of the year, forever, Sonia Meskin, BNY Mellon. We'll do that here in a moment. Markets rally, futures up 15, Bloomberg's surveillance from New York.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. A world beater, Agnes Tirop, was found dead today.
When you're moving into the career of athletics, you have to carefully look at who are the important people in your life. Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
The Fed is moving off center stage. The Fed is going to have much less of an influence on where rates go from here. But unfortunately, that doesn't mean that the volatility is going to go away. Why is the Fed done? Because they're going to get the air cover from headline inflation coming down very rapidly. So even though core inflation is going to be sluggish, they're going to get air cover from headline inflation.
That was Mohamed El-Arian, Bloomberg opinion columnist and Queen's College Cambridge president, speaking with John Farrow yesterday at a time when many people are expecting the volatility in treasuries to continue regardless of what the Fed does. John's off preparing for that 9 a.m. hour. Tom Keene here, Lisa Abramowitz, as we head toward the opening bell with a lift, a Tom Keene strength to the S&P futures of 0.4% as yields continue.
We got the VIX is under 15. Come on, 14.95. That's because of the 30-year bond auction.
Okay, so this is the question: does it stick or not? I do. Before we want to get to our next wonderful guest, I do want to just give you a sense of one share moving this morning. Diageo, in addition to Richemont, we were talking about Richemont earlier, the Swiss watch maker, but Diageo, which is the parent company to Johnnie Walker and Smirnoff vodka, those shares plunging the most on record after cutting the outlook, with the head of the company saying that there are materially weaker performances in Latin America and the Caribbean.
This is a huge deal. There's any number of ways of looking at this, and if you go to LVMH, the singular disappointment for LVMH was, of all things, cognac sales in America. And in the fancy look, I'm I'm not an expert at this, but in the fancy liquor part of the luxury business, I think crater is the operative word right now.
Well, do you think that this is something
Nastiagio.
specific to the liquor market, or is it something that people are moving more to craft or to specialty things, which was a trend, or do you think that this is actually indicative of luxury demand? I mean, that to me is one of the key questions with the two-pronged spirits and watches.
I mean, I'm going to make this up. I'm going to deal with our wonderful people in London who are expert at this, but the bottom line is I think there was a pandemic acquisition. And yeah, Lisa, maybe you don't down a bottle of cognac in one night. I just don't think that's the way it works. So, they bought in, and, there's a long and variable lag here.
Although,
as you look at the cognac sales.
Arguably, that long variable lag during the pandemic was less. Let's move on
Let's
now.
move on.
So joining us now is Sonia Meskin, head of U.S. Macro at BNY Mellon Investment Management, as we head into a potentially volatile week next week. Keyed off with some of that retail spending, do we have a sense, just sort of sticking with luxury, of how much some of the warnings that we're hearing in the spirits and in the watchmaking stocks indicate something broader?
Well, it's tough to say. I would point out that these are items that were very popular during the pandemic. They may be subject to an ongoing reversal with some long and variable lags that you guys just mentioned. But that said, those are just a couple of sectors. There's certainly others that are doing much better.
You take a more cautious view here. Have you capitulated from a more hard landing, a more strident 2024? Have you eased that back, or do you stand with a cautious view on disinflation?
Well, here's the thing. We have been pretty sanguine on the probability of a soft landing for at least a couple of months now. We don't really believe that has changed very much, but we still also believe that the tails of the distribution remain fatter than usual. And we do think that heading into 2024, we could get a delayed but harder landing.
But I love what you say here in your research note. You call it a slam on the brakes, 2024. How does a central bank as visible as the Fed, quote unquote, slam on the brakes?
Well, we now all believe the Fed is done. What if inflation stays sticky and employment stays strong? They're trying to thread the needle now. They're worried that not only will inflation stay sticky, but employment might actually weaken considerably. What if that doesn't happen?
And out front on this was Jim Bianco of Chicago, who was one of the first people to say to me, what Sonia's saying here was, okay, celebration, and then we go level. That's what Lagarde's talking about. We go level. We don't keep going down.
The gap, the range of potential outcomes is sort of shocking to me. And the fact that we've got some people on saying exactly what you're saying, the risk of accelerating inflation and growth is really significant, and other people saying we're going to head toward a hard landing and rates are going to go near where they were before, sort of as a benchmark rate with inflation, just highlights why you're seeing ping-ponging yields, because nobody can figure it out. What will be your guide to understand when that risk shifts and becomes a little more visible in terms of which of those two extremes we end up with?
I think in terms of the economic data specifically, it's important to watch what happens with the potentially stickier components in the early 2024. We know that some areas such as rent inflation, medical care, there are some dynamics there. They're just kind of base effects. How will that play out in 2024 once those wane are important. And also what happens with the participation rate and with employment gains, because a lot, like we discussed here, a lot of the participation gains have been helpful in the, to contain some of the wage growth, but it's mostly come from foreign-born workers. Will that continue in 2024?
Do you have a sense of whether the long and variable lags are just very long, or whether they've already been baked in a little bit more than people previously expected, right? I mean, this has been one of the also big debates. And Chair Powell talked about this yesterday. He said it has been perpetually surprising how strong this economy is, given how much tightening we have done. Have we gotten any clarity on that whatsoever?
I think the bigger corporates that have refinanced early during COVID are still doing very well by and large. The smaller businesses are suffering more, but for that to percolate into the broader economy may take a long time.
Markets on the move right now. Futures up 19. We're going to print 20 here on Standard & Poor's futures up 0.4%. Dow up 144. I didn't do a fancy Fibonacci here, but we're basically 50% back to where we were before the carnage yesterday. The VIX, Lisa, stunning 14.88. The 10-year in a solid 5 basis points.
I'm glad you brought that up because we've seen this incredible volatility, particularly in benchmark full faith and credit yields. Does that affect the economic outlook in a material way?
It could, but over time, because it does affect how corporates refinance themselves. The bigger the refinancing needs, the bigger the impact. And I do think that that's going to be a theme into 2024.
Do the formulas work right now? Does the math work right now, or are we just making this up post-pandemic as we go?
You know, so Dana Peterson, who was on here before, made a very good point. The leading indicators are mostly predicated on the goods sector, not services. And the big question right now is more in services. Will the services inflation remain sticky? What will employment be in services?
So retail sales next week, that's a services view, even though we're buying goods.
Well, I think it's both. I think it's both.
But that to me highlights why this has been such a difficult period to get your hand around. I remember earlier this year we were talking about a rolling recession and different industries that were going through downturns at a different time. And there was this question of whether we would see some coalescing around some downturn or some recovery. Where are we in that sort of revolving chain of economic cycles that doesn't seem to be coming together?
Well, it may be a longer cycle than we'd anticipated. It sounds like, at least through the end of the year, we're looking at still a pretty robust economy with potentially some gentle decelerating that could be welcome. 2024 is really the bigger question.
I got a chart out here of the VIX, too quick to make it for television. Radio, this chart looks great on radio. And I got a double leg VIX move yesterday, Lisa. We just made back all of the Powell comments move, and now we attack the 30-year angst of yesterday.
Well, right. I mean, this has been the volatility with people trying to get a handle on how much to have faith. Just quickly, so around this, though, is shocking. How much conviction do you have that we're going to see a real drop-off and potentially downturn?
You know, I think people do expect some deceleration and potentially bigger one than is currently priced in. But I do think the big issue here is timing.
Right.
And because it's so difficult to time, it is also difficult to price in.
Sonia, thank you so much for the brief here on a Friday. Sonia Meskin with us, BNY Mellon, with some really good overview. Getting into the data next week. Lisa, you talk about whiplash, whipsaw. I mean, this is, seriously, you nailed the auction from 12 noon yesterday, let's call it 21 hours, I guess.
You nailed the optimism that would be coming out today and that it was all over. So, you know, tit for tat.
I'm borrowing from, who am I borrowing from? Andrew Hollenhorst, Jan Hatzius, and many others. Something's in the air. It's not me. That's what people are saying.
It's a holiday spirit. It's
a holiday spirit.
Well, no, there's something in the air. I like how Michael Hartnett over at Bank of America said that we've gone from bearish to full bull pretty shortly.
I like that.
And
I
this
missed
idea of just, greed taking over fear in a massive way. And a lot of people are saying, lean into it, I mean, embrace it because, we only have so many months left in 2023 and kumbaya.
Thank you to all of you for John Farrow's interview with Christian Harner. We're going to lead with that on Monday. Joining us on Monday, a far more troubled leader of Formula One, dealing with a difficult car, and also Sir Lewis. Toto Wolff will join us in the 6 o'clock hour on Monday before the Las Vegas Grand Prix. From New York, good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television.
Have you thought maybe I should go do something else? I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
This is Bloomberg.
A bit of a snoozy morning so far. Let's see if that changes. Trying to bounce back from yesterday. Live from New York City this morning. Good morning, good morning. Your equity market positive by 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Live from New York, coming up, a 1-2 punch puts an end to an 8-day winning streak as a very sloppy bond auction spooks investors, and Chair Powell says we're ready to hike if needed. We begin with the big issue, a volatile bond market.
We all want more stability in the treasury market.
Need for a little bit of a stability of yields.
Having 8 to 15 basis points moves every day as something regular is not good.
10 basis point days in the treasury market seem to be, a snooze. It happens all the time.
The treasury market is central to so many other markets.
The yield volatility that we see in fixed income has been driving a lot of what's going on in the rest of the markets.
Going forward, there's a lot of issuance that has to be done.
The distribution of risks have changed.
We have a tug of war that we're going to see playing out between issuance and between a softer economy.
Still really a good chance that we're going to see a lot of volatility.
The further out you go in the curve, the greater volatility you're going to see.
Volatility is going to be the key throughout most of 24.
There's still a lot of underlying tensions in that bond market.
Let's talk about that tension. Joining us now to discuss this, SocGen Subhadra Rajappa, PGIM's Greg Peters. To the both of you, thanks for being with us. Subhadra, let's start with your own words. Why are bonds so unhinged?
I think yesterday's auction definitely caught everyone by surprise. It might be because of factors that are outside the control of the markets. But even outside of that, leading into this week, my biggest concern was that there's a lot of supply that the market has to absorb, and the liquidity in the market was relatively poor. The question was if investors would actually show up to take down the auction. We've had 10-year auctions tail for the last several auctions. The 30-year auctions have been weak as well, but again, it's a question of the fact that it's not just about this week's auctions, but also increasing sizes for the next 6 months or so. At the next refunding, we're expecting larger issuance sizes for 10-year and 30-year bonds. So this sort of problem is here to stay and needs to be addressed as soon as possible.
We had a big rally coming into this week. Greg, we moved on a 10-year from north of 5%. We dropped below 450 early this week on a 10-year maturity. I've been asking, Greg, I'd love your response to this. Have we confused the recent rally with stability?
Yeah, I think the market just continues to lean the wrong way. And so at any point in time, the response is Fed cutting, rates rally, and I think it misses kind of what's going on. And so the auction tail was just kind of representative of, 50% retracement, shakes out a lot of, demand. And so the response was, pushback. And so, I think the market just continues to kind of think through this improperly, and always pushing rates down at any point, I think, is a mistake. So vol's here to stay, Jonathan.
Greg, how do you think we should be thinking about it?
Well, so I think we should listen to what the Fed says, and I think what catalyzed the move yesterday, the auction clearly exacerbated it, was Powell's comments reiterating what he said all along. But the market continues to disbelieve this higher for longer, that they're vigilant around inflation. The market wants the Fed to cut at any time that there's room for that commentary to come through. So I think you listen to the Fed, and that means rates are higher for longer.
This is what I hear from Citi as well. Over at Citi, Andrew Honhorst writing the following this morning: the Fed's on hold, and the bar to hike will likely not be surmounted even by the upcoming 3 months of stronger core inflation data. There's almost a sense of disbelief right now, Sir Badger, around the Fed speak. There is just this overwhelming belief this Fed is done and won't respond to hot inflation data, even if we get 3 months of it. What's your take on that?
Well, I think the concern, at least in the bond market, is that the Fed has already hiked a lot. They've told us that long-end yields have gone up quite dramatically. Term premium has risen as well. And the rise in term premium is really doing the Fed's job of tightening financial conditions. So they kind of told us that they're not really thinking about hiking aggressively from here on, given the fact that the rise in term premium is doing the job for them. The real concern right now is that if financial conditions do ease, we saw 10-year yields and 30-year yields decline by nearly 50 basis points in the last week, then the tightening of financial conditions becomes easing of financial conditions. In that sort of scenario, the Fed would have to then hike rates to counteract the easing of financial conditions, and then it becomes a little bit of a vicious cycle. So that's really the bigger concern for the Fed, and that's why we saw this sort of pivot into much more hawkish speak yesterday from Chair Powell.
We've had a week full of Fed speak. We've got some more for you right now. Atlanta Fed President Bostic speaking. Inflation is too high. Must do all we can to get it down. Mike McKee, the Federal Reserve, on repeat.
The Federal Reserve is on repeat. This whole week has kind of been like listening to your mom saying, boys, stop wrestling. Don't make me come up there. That's Jay Powell's message yesterday. Don't make me come up there to the bond market. He used the same language he's used before, but just stacked it in such a way that it appeared hawkish. A long way to go to the 2% target. We're not confident rates are sufficiently restrictive, and we're going to be cognizant of the risk of being misled by a few good months of data. In other words, we're still keeping a rate rise on our table. Now, did it do a whole lot? Not really. You can see this is the week of trading in the Fed funds futures for June. The market moved up the idea of a rate cut to June after the Fed meeting last week and then the jobs report. And Powell retraced that a little bit, but it's coming back down again here. The market, as Greg Peters says, is not listening to the Fed. But of course, if you're the market, you need somebody to buy your securities, and that was the other half of the problem. Look at what happened yesterday with the 30-year. These are the stats. You know the story. Stopped through at almost 4.7%, a 5.3% tail, basis point tail, rather. Low bid to cover ratio, and primary dealers had to take down the most in 2 years. It was basically called a dismal auction. People did not want these securities at the prices that the government was hoping they would pay. Now, does that make a big difference, or does Jay Powell make a big difference? It was clearly the auction. You can see the movement in the 30-year yesterday from the auction, and then Powell a little bit later, just kind of the cherry on top or something like that, not really making a difference. So going forward, is the market listening to the Fed, or is it going to take the market telling the market in the auctions that something needs to be done?
Close the door. That's what I thought you were going to say, Mike. Close the door.
Well, yeah, close. I mean, he did have some good advice for the security people at the IMF.
Close the door. Mike McKee, thank you very much. Enjoyed that yesterday, that's for sure. Let's go through the curve together. 2-year, 10-year, 30-year. 2-year right now, 498. Yesterday, a close above 5% for the first time this month, which also coincided with the first down day for the equity market for the first day in November. On the 10-year, we're down about 5 basis points this morning to about 457. 30-year, 472. Difference between the 2 and 10-year right now, that spread about 40 basis points. The 2 and 30-year, that spread about 27. Let's talk about that if we can, Greg. Why you think the shape of the curve should dictate where you want to be. Just explain that for us.
Yeah, so I think the shape of the curve explains everything. So why would you see tremendous demand in auctions or secondary when you still get a higher rate to be in cash? And so if you bite down on this notion where the front end's going to remain higher for longer, inflation is above target, growth is actually pretty reasonable, why should the curve be inverted? And so I think it's quite fundamental. I don't see demand really coming in until you have a normalized curve. And so it's not as inverted as it once was, but the data has kind of supported a much more normal curve. And honestly, I think you need to see, a positive reading, 2s, 10s, 2s, 30s, really to entice investors into the marketplace.
Subhadra, is that your view as well?
Yeah, no, I agree with that. And part of the reason why the curve's been this inverted this time around in this cycle is because of the fact that the Fed's been holding a lot of treasuries in its portfolio and it's gradually unwinding its portfolio. So the buildup in term premium is happening, but it's not happening as fast as one would expect in any sort of a cycle. So So I agree with Greg. I think that it does make sense for some amount of term premium to get built into the long end to entice investors. So on a duration adjusted basis, the 2-year, even the 5-year part of the curve looks very, very attractive to investors. And that's really where you're going to see a lot of the demand for treasuries. And of course, there's a lot of bills as well. So you see money market funds come in and participate in the very, very front end of the treasury curve. So it's all much more focused on the front end. So the long end is really struggling.
To that point, Greg, do you have a bias on how you think the curve should steepen? Is it a 2-year yield coming in, the 30-year breaking out? Which one is it?
Well, so the answer is always a little bit of both, but I think it has to be more back-end driven. So I do think there's some scope possibly for the Fed to modulate rates into next year slightly. But I do think if growth remains, reasonably strong, inflation remains above target, I think that back end does most of the work. So, so I see more volatility, 10s through 30s, well into the future as a result.
You're not alone. I heard the same thing from Mohamed Al-Erin yesterday. Greg Peters, Subhadra Japa, sticking with us. We're about 20 minutes out from the opening bell. Equities on the S&P 500 positive here by 0.4%. Let's get you some movers. Here's Abby.
What makes that interesting, the fact that we have futures higher, John? We have tons of big laggards to the downside, but let's start out with a couple of leaders helping out the futures, including Apple, which is higher on perhaps the news that they're set to appeal the App Store's inclusion in EU dominance. Rules are basically filing a challenge over digital markets, the Digital Markets Act in EU court. Coinbase and many of the other crypto stocks higher with Bitcoin, and a big piece of this has to do with BlackRock's new Ethereum ETF to be listed on the NASDAQ. As for those laggards, there are so many big ones, but they don't have big weightings to the indexes. Plug Power being just one example, down 37%, the worst day in at least a year. They put up a weak third quarter. 2 analysts downgraded them. Some of them are saying that there's going concern risk here on high cash burn. The stock though, John, this is not coming as a surprise to everybody. It had been a $70 stock back in 2021. Into this print and this 37% slide, already down more than 90%.
Brutal. Abby, thank you. More from Abby around the opening bell. Coming up, a cyber attack disrupting the U.S. Treasury market.
We haven't had something like this happen before. It seemed like the when-issued market was okay going into it. There were a lot of questions because we've had such a big rally at the long end.
The world's largest bank falling victim to a ransomware attack. That conversation up next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point, what is the lesson or the observation?
We haven't had something like this happen before. It seemed like the when issued market was okay going into it. There were a lot of questions because we've had such a big rally at the long end. You started to get the Powell comments, and then you got the hack, whatever that may have had to do with it. But we'd had such a big rally going into it after the 10-year went well and the 3-year went well. I think that had something to do with people stepping back.
What a strange 24 hours in a bond market. Now, we learn that ICBC, the world's biggest bank, hit by a cyber attack, leaving the Chinese bank unable to clear US Treasury trades and forcing employees to send settlement details through a courier carrying a USB stick. A spokesperson from the Treasury Department saying this: "We're aware of the cybersecurity issue and in regular contact with key financial sector participants. ICBC is now conducting an investigation." Joining us now for more is Shonali Basak. Hey, Shonali.
Good morning, John. This is certainly a nightmare starting to come true for the market. Remember, when you think about the Treasury market, it is surprisingly opaque with a lot of bilateral dealers that people look to, and ICBC in the last 5 or 6 years has gotten much, much bigger. It's China's largest bank and the world's largest bank by assets, but really, the real fear here is not just about ICBC. It's the idea that this could happen to anyone. We saw this week that the ICBC ransomware hacked, really suspected by the Lockbit gang, which is a criminal ransomware gang that is quite sprawling with ties to Russia, but really with ties around the world to different hackers. We also know here that it really did impact the Treasury market in real time this week during an auction that was also already sensitive in and of itself. We have a lot of vulnerabilities when you think about the way debt is being issued, and that longer end of the Treasury curve is of critical importance here, and we did see demand come down on the heels of this attack through one dealer. Now, when we look at ICBC as well, we have to remember that the SEC is trying to change its rules. It's trying to make clearing more centrally cleared. But one of the worries and the counter-argument to doing this here is, what if a centrally clearing agent, the DTCC, for example, gets hacked? There you have bigger issues when you think about the plumbing of the financial system. We've seen in fits and starts hacks like this before. For example, a electronic trading firm based out of Europe, really impacting the derivatives market this year. But if you look around everywhere you go, the financial industry is very concerned about more of these hacks. What if the Fed were to get hacked? What if the DTCC were to get hacked? What does that mean for really gumming up critical infrastructure in the financial system, as we saw yesterday at effective prices in real time?
Really, really important question. Shonali, thank you. Back with us for some final thoughts. Arbitrage Jappa, Greg Peters. Greg, it's really difficult to answer this question. Just what we saw yesterday in terms of the Treasury market, how connected might it be to the struggles of ICBC? How difficult is it, Greg, to answer that one?
Well, I just think it was a perfect storm yesterday. There were, so many issues at play happening all at once. That was one factor. Clearly, the integrity of the system is never something you want to question. But this is why regulators are laser being focused on central clearing, particularly around repo. There's implications around that, so it's not so easy to fix necessarily. But yeah, it was more of a perfect storm yesterday than one just single event.
Greg, one thing I'm looking at right now is maybe a little bit of stability on the screen at the moment. But stability these days is like 5 basis points in either direction. Greg, do you think we have to get used to just bigger moves in the Treasury market, given what we have seen in the last few weeks?
I think so, right? I mean, so volatility has been running well above trend. It's not as high as it was, 6 months ago or even a year ago, but it's still, quite high. And so this is just the environment that we're in, right? So we're funding very large deficits. You have, less liquidity in the marketplace. You have a data-driven Fed and central banks across the world. And, these powerful moves are something that we have to get accustomed to. So what are the knock-on effects? I don't think we fully know the answer yet, but I don't think it's necessarily positive.
And yet clients still want price targets, Subhadra, so let's go through them. 450 for year-end, I believe it was. Is it 375 into next year? Is that still the call from you and the team, Subhadra?
Yes, I think that 10 yields are probably going to stay in and around 4.5% for the remainder of this year, because the data that we're expecting is going to be relatively strong in the fourth quarter. Nothing that would suggest that a recession is imminent. But then going into the first quarter of next year and the second quarter, our economists actually have a recession penciled in for the middle of next year. So under those circumstances, as the weak data starts to trickle in, perhaps even as early as the fourth quarter, but really in the first quarter of next year, then you should start seeing yields continue to decline from here on. But the liquidity profile is very important. The fact that the market is really pushing back on taking down the supply is another key component. Really, the big picture issue in the events over the last 4 hours is that we've had a lot of supply, and we are going to get a lot more supply.
It's a snoozy morning. Nothing snoozy about the last 24 hours, that's for sure. Subhadra, Greg, thanks for being with us this morning. We can take a break now. The New York Stock Exchange and the NASDAQ observing a moment of silence in remembrance of all those who have served in honor of Veterans Day.
Kenyan athletes are getting better and better, and their times are getting quicker.
Agnes Tirop takes the win and the world record.
With all the success, there also is a dark side to it. And this comes about when men in the community look at women as prey.
The sports fraternity is in mourning tonight. Our world beater Agnes Tirop was found dead today.
When you're moving into the career of athletics, you have to carefully look at
Who are the important people in your life? Even in a partnership, it can move into manipulation.
A lot of people let Agnes down. She felt that the threat was real. What she was told is exactly what happened to her.
DOJ or other authorities
could face bigger challenges next.
Fed was going to keep rate World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
We are a little more than 6 minutes away from the opening bell. Equity futures with a bit of a lift here on the S&P 500, snapping back, bouncing back from yesterday's losses on the S&P higher by about 0.4%. That's some of the price action. Let's get you some morning calls. Your first one from BNP, downgrading American Airlines to neutral, $12 price target, seeing continuing macro and cost headwinds. Your second call from Baird, upgrading Toast to outperform, expecting shares to benefit from strengthening revenue growth. That stock is up by 2.66%. And finally, Barclays raising its Groupon price target to $7 despite missing on earnings, applauding management's recent turnaround efforts. That stock this morning is down by 27% and getting absolutely hammered. Let's stick on the earnings, shall we? Better than expected results fueling Disney's best day of gains in nearly 3 years in yesterday's session. Abby has a couple of other media stocks this morning. Hey, Abby.
Hey, John. Yeah, it was an impressive day for Disney yesterday on that strong quarter and the outlook of cost cutting. But today we have a leader and a laggard, starting off with the stock that is down just a little bit, but well off of its lows. News Corp had been down into the print, down 6%. On the Bloomberg terminal, it's showing down just about 0.3% or so. They put up a top and bottom line beat. They put up adjusted earnings of 16 cents, better by 37%. They also put up better revenues of $2.5 billion. This is, of course, the parent of the Wall Street Journal. Well off of those lows, and on the year, not so shabby, up 17%. But take a look at Lionsgate, up 7.5%, a robust quarter, standout $133 million worth of free cash flow, in part because of the strikes. Stars and the studio helped as well. This stock, John, up 59% on the year. So when you think about Disney, which did just put up that good quarter, but down on the year, maybe there's some catch-up potential for Disney, given the fact that their results seem to be improving, cost-cutting, and the media space overall doing really pretty well on a year-to-date basis.
Cost-cutting a big factor there, that's for sure. Abby, thanks for the update. More from Abby around the opening bell. Let's touch base on the broader markets, go through equities, then bonds, and finish on foreign exchange. About 5 minutes away from the opening bell. Equities elevated by 0.4% yesterday, snapping that 8-day winning streak on the S&P 500. The rally was inspired by a bond market rally. The sell-off yesterday encouraged and fueled by the bond market sell-off. The 30-year with a big move higher on a yield yesterday. The 30-year this morning lower by 4 basis points, 4.72. On a 10-year, we're lower by about 5 basis points at 4.58. Coming up, RBA's Dan Suzuki seeing mounting reasons to buy this equity market. That conversation is coming up next. Your opening bell is just around the corner.
This will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. A new industry is poised to launch. Electric air taxis are on the horizon.
You will see these products come to market by the year 2025.
CFO Mark Messler has Archer Aviation on a financial path to a smooth takeoff.
I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
Watch Chief Future Officer Wednesday on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
24 seconds away from the opening bow this morning. Good morning. I think we all needed a quieter morning, didn't we? We've got one so far. Equity futures on the S&P 500 positive by 0.5%, bouncing back from the first day of losses for the month of November after snapping that 8-day winning streak on the S&P. There's your opening bow. Switch to the board and get to the bond market at the epicenter of your hopes and dreams, your fears and nightmares. Yields lower by 4 basis points this morning, 458 on a 10-year yesterday. Yields, double-digit moves across the curve, 2s out to 30s. We had the first close north of 5% on a 2-year for the month so far. Now we're back below that level on a 2-year yield, lower by 3 basis points to about 498, 499. With that, the euro showing some strength against the weaker dollar, 106.84 on that currency pair, positive by 0.1%. Crude, still in the 70s, but higher this morning by 1.5%, let's call it that, round it up, $76 and about 86 cents on WTI crude. About 30 seconds into the session, equities look like this, positive by 0.4% on the S&P and just about positive now, I think, on the week as well. On the Nasdaq, up by 1/3 on the session, about 45 seconds in. One stock to watch at the open, Wynn Resorts. Shares moving sharply lower on weaker than expected numbers out of Macau. The CEO highlighting the positives, saying this: the recovery in Macau continued throughout the quarter, with particular strength in our mass gaming, luxury retail and hotel businesses. Abby has more. Hey, Abby.
Hey, John. Well, it's interesting because there's so much going on here. So relative to those comments about Macau, it's Barclays is saying that the margins and the commentary were actually disappointing, yet saying that the Macau numbers beat. Now, relative to the overall surface numbers, it was a big beat, yet we have the stock down the most since October of 2022. I was mentioning tons of laggards before. This is one of them, a well-known casino operator. They beat earnings by 33%. They beat revenues by 5%, $1.67 billion. So not small numbers. But it has to do with Macau, because Las Vegas, those numbers were very strong, and analysts do seem to agree that the commentary, the look forward on Macau is what's disappointing. We've been hearing a lot about luxury spending and the consumer in China slowing down to some degree. This could be certainly a piece of it. Macau does 19% of their revenues, but even so, something else to keep in mind here, John, the stock on the year up, it is higher by, let's see, about 9%, and yet there's a 7% short interest, so those bears creeping in. And then one other piece of news, of course, the Las Vegas strike was averted as Wynn Resorts is one of the last to round out the labor deals there. So lots going on, but one thing is clear, Wynn Resorts, the stock right now, the worst day in more than a year, down about 8%.
Close to 9% now. Abby, thanks for that. 82.92 in early trading. Let's turn to the autos. Tesla looking to rebound from its worst day in nearly a month. This after President Biden supported the UAW's push to unionize their employees. Ed Ludlow tracking this one. Hey, Ed.
Yeah, John, Trump
trying to rebound is the right way. We're basically flat on the stock, maybe softer, 0.1%, but technically down for a third straight day. There was kind of a confluence of factors Thursday when Tesla was the biggest points drag on the S&P 500. The biggest factor being, as you said, Biden saying he, quote, absolutely supports the UAW's effort to unionize Tesla, but also name-check Toyota. I know you tracked that spike in yields Thursday as well, and then you kind of come back to the Tesla story and what it is. It is a risky growth stock and is impacted by both the rates narrative and some sensitivity to yields. There was a beautiful sell-side note out that I wanted to read you. HSBC initiated the stock with a sell equivalent, saying, our caution stems from the uncertainty around the timing and commercialization of Tesla's varied ideas. I think there's just a lot going on with Tesla that might happen in the future or might not, but we're on a sustained downward trend since earnings, where Elon Musk did bring up the impact of higher rates.
A beautiful south side note. Ed Ludlow, thank you. That stock positive by, let's call it 0.2%. Let's turn to media, shall we? Lionsgate, News Corp, both topping estimates. The Lionsgate CEO saying this: we are reaffirming our guidance for the full year, even with the negative impact of the strike. Simone Foxman has this one. Hey, Simone.
Hey, John, yeah, and if you want to put a figure on the impact of that strike and its resolution, you only look at Lionsgate earnings. So Lionsgate coming out around just after 4 p.m. after the close of trading yesterday, but we didn't get the call until about an hour later. Shares didn't move immediately until the call. And one of the things we heard on the call was that the impact of the Hollywood strike would be less than initially anticipated. The executives there pegging that at approximately $30 million. So seemingly a result of what happened in that Hollywood strike. More broadly, though, we're looking at media companies leaning heavily into the digital transformation in the space. Lionsgate, for example, has invested heavily in Starz streaming, despite pretty substantial costs, but at least in this latest quarter, able to not just surprise profit, with adjusted earnings per share coming in at 21 cents versus an estimated loss of 7.5 cents per share. Motion picture revenue up about 77% year on year. When you kind of contrast this with News Corp, gone a very different direction, looking a lot these days like the New York Times instead, but they were able to beat as well, and adjusted earnings per share coming in at 16 cents over the 12 cents anticipated, led by that Dow Jones Digital Network. This is really important, though, by Starboard, because Starboard Value has taken a larger position, wants to make strategic changes, especially perhaps spinning out the real estate unit, which actually looked a little bit better than most people anticipated. So both media companies in the state of transition, but only one having this Hollywood strike catalyst, and maybe that's why we're seeing shares of Lionsgate up today of over 5%, while News Corp down over 1.5%.
Simone, thank you. The latest on Lionsgate and News Corp there. Check out shares of Groupon. You know a stock is facing some trouble when you're down about 32% and it's not even your worst day of the quarter. That's where the stock is right now, falling as results miss and the co-founder resigns from the board. The interim CEO saying this: while we did not make as much progress on key projects as I expected and our business continues to be challenged, I am pleased to see sequential improvement. Katie, your challenge to explain this one. Morning.
Well, I'll tell you, it's a bevy of bad news for Groupon, which, if you don't remember, it's basically a website for finding group coupons, get it to restaurants, local events, etc. It also reported earnings yesterday. It did not go over too well. The adjusted loss per share was 12 cents. The estimate had been for an 11 cents loss per share. So adding to that, as you mentioned, you also had Groupon's co-founder announcing his decision to resign as a member of the board effective that day. And finally, Groupon also announced a plan to raise about $100 million through an equity rights offering, which might explain why the shares are down almost 32% at this moment. Barclays noted that that equity rights offering, it's likely going to weigh on the stock, and that shares could also remain under pressure. Quote, recovery expectations are getting tempered a bit. So you add it all together, like you said, this is only Groupon's worst day in about a month, though I will note that through yesterday's close, the stock was higher by 58% this year, so it's going to be one to watch.
Volatile, that's for sure. Katie, thanks for the update. Here's your update in the broader market. 7 minutes into the session, we're just about positive on the day, just about unchanged on the week. We're positive by 0.25% on the S&P 500. On the Nasdaq 100, bouncing back by about 0.5%. Dan Suzuki of RB Advisors discussing the rapidly shifting narratives in markets, writing this: a few weeks ago, interest rates were hitting 16-year highs, and the equal-weighted S&P 500 was about to fall back into bear market territory. What's changed? Modestly better issuance outlook from Treasury and some softer economic data. Dan, I'm pleased to say, joins us right now. Dan, call it what you will, and great to catch up with you, buddy, as always. We've called it narrative roulette, narrative table tennis. Dan, what explains the shifting back and forth between things are great, things are terrible, things are something in between?
Well, I think, nice to see you, John. I think, part of it is explained by just the changing narrative, or changing makeup of the market. I think, the quick, quantitatively driven, algorithmically driven, players in the market cause wider swings, so you get these bigger amplification of moves in the market. And then there's just the overall sort of aspect that we are late in the economic cycle, not late in the profit cycle per se, but late in the economic cycle where it's just a tricky time. Better growth means a tighter Fed, and slower growth means you might be going through a recession. So I think the market just in one extreme to another, whereas if you look at the actual underlying fundamentals, it's not moving that rapidly.
Dan, you get some softer data, and you know what people start to say. It's not too hot, it's not too cold, it's just right, it's Goldilocks. Is Goldilocks a moment in time, or do you think it is the ultimate destination, a condition we'll have to live with for a while?
Jonathan, I think Goldilocks is a moment in time. I mean, look, if you look historically, rarely is there any time where you just sort of consistently in a steady state. Typically things are getting better or they're getting worse, and you go through these cycles over time. That's why they're called cycles, economic cycles and profit cycles. And so, it's Goldilocks where you're sort of at this intersection of different aspects where inflation is coming down and lags, and growth, is picking up, but also, hasn't really re-accelerated yet. So I think, that's probably where we sit today. We're late in the economic cycle. So as we get, later into next year, growth is really holding up well, and perhaps accelerating, then we're going to have to contend with potentially a tighter Fed than people expect, especially when they priced in more cuts.
You've done it twice now. You've drawn a distinction between the economic cycle and a profit cycle. Can you explain that a little bit more, and how you think that's going to track in the coming 12 months?
Absolutely. I think this has been the big distinction. I mean, if you just look in the backward, in the rearview mirror here, I mean, we just got the GDP print for the third quarter. Nominal, growth was like 8.5%. Meanwhile, if you look at profits growth, this third quarter came in better than expectations. It's basically, year over year. By most accounts. And so, there's been this distinction of a profits recession and pretty stable economic growth. And I think that's, what people don't realize is that is a disconnect going forward. We are early in this profit cycle recovery. We think the jury's out there. The profit cycle, troughed, at the end of last year, and it's been trying to steadily recover here. But the economic cycle is already, there's less likelihood of a huge surge in acceleration from here. So that's kind of what you have to contend with, is just this continued disconnect between the profit cycle and the economic cycle.
In the meantime, Dan, how do you want to play that? If you want to play that profit recovery cycle, how do you want to play that? Where in the equity market?
Well, I think typically what you want to go do is you want to go buy cyclicals, right? Because the cycle, the profit cycle, is determined by the cyclicals. And so whose profits are going to accelerate the most and benefit most from that environment? It's the cyclicals. And if you look today, there's two types of cyclicals. There's expensive, crowded cyclicals and cheap cyclicals. Well, we contend that you want to own the cheap cyclicals, because as growth becomes more prevalent and more companies have stronger growth, then the investors can become comparison shoppers, and they can look toward cheaper areas, access to that improving growth outlook.
Is this the argument for the equal weighted S&P then?
Yeah, I think that's one way to play it. I mean, our view, and you know this well, is there's one crowded, expensive part of the market, and if you look everywhere else, you could throw a dart at a dart. Out there is cheap, and so a lot of that stuff is cyclical. It's international, emerging markets, value, small caps, all that stuff. I think is very much going to benefit from the dynamic we're talking about.
I've heard that a lot from you, Dan, all year. So I've got to push back a little bit, because why can't the expensive stuff just get more expensive? And can you really miss out on some of these gains we're seeing in big tech? I look across the screen, as you know the numbers anyway, but for the people that don't, Nvidia's up more than 200%, Meta's up by 167% year to date. Dan, why shouldn't I just stick with the things that are winning, the things that are done well?
Well, I think if you follow that recipe historically, I mean, you do well. Momentum works until. So I think the issue here is that I think that the underlying macro fundamentals have shifted. I think over the long term we're going to be dealing with higher inflation, more higher interest rates, and I think that's going to be a headwind for some of these more expensive names. In the near term, I think, again, as I said before, as growth reaccelerates, I think a lot of these companies will see their growth accelerate as well. It's just, investors will become comparison shoppers. Why pay 30 or 40 times for companies who are going to put about X amount of growth when you can buy companies that trade at a fraction of that multiple that will give you better access to better growth? So I think that's just a normal cyclical dynamic. So the difference is we're at this inflection point. 6 months ago, growth was very, very weak. And so you could flock to the companies that had, very, very good growth prospects. Now growth prospects are improving everywhere. And I think that's the difference now.
Dan, appreciate the clarity. Always do. It's great to get an update from you and the team. Dan Suzuki there from RB Advisors. The broader market right now looks like this. About 13 minutes into the session, we're positive 0.4% on the S&P, and the Nasdaq up by about 0.6. Coming up, President Biden gearing up for a high-stakes meeting with China's Xi Jinping.
The United States has no desire to decouple from China. A full separation of our economies would be economically disastrous for both of our countries and for the world.
Remember, decoupling, that's unacceptable. You have to say things like diversify. We're looking to diversify. Team coverage from Capitol Hill up next.
Names at the Fed are on Bloomberg.
The economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough.
The bond market has tightened quite considerably. If financial conditions are sufficiently tight, our work is not necessary because we don't need to boost them more.
Nobody covers the Fed like Bloomberg. Context changes everything.
I do think what we are going to find is that outside of a very few industries and sectors, governments are not going to be willing to subsidize indefinitely production that brings it home or brings it to allies. And so the benefits of international supply chains that we've seen over 40 years, from economies of scale, from specialization, from innovation and the like, those aren't going to go away. And so if you don't have an international supply chain, you will be beat out by competitors who do.
So I think what we're looking to do is to maintain a trade policy which is based on openness, which is based on sustainability, which is assertive, where we need to be assertive and defend our rights, but certainly not one which is going to be closing down unnecessarily our trade and investment relationships with the rest of the world.
Globalization, that open supply chain, global supply chain is really important for the life science industry, particularly pharmaceutical supply chain. You think about the stress the pharmaceutical supply chain has been under since COVID-19, the war in Ukraine, not to mention the geopolitical tensions, if you will. We don't have the luxury of saying we can temporarily stock out on our product, because these products, these medicines keep people alive.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew, alongside Kaylee Lines, deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
United States has no desire to decouple from China. A full separation of our economies would be economically disastrous for both of our countries and for the world. We seek a healthy economic relationship with China that benefits both countries over time. The United States will continue to take targeted actions to protect our and our allies' national security.
Secretary Yellen setting the stage for a highly anticipated meeting next week. President Biden sitting down with China's Xi Jinping for the first time in a year, looking to maintain America's role on the international stage while also supporting two military fronts abroad. It's a tough balancing act entering a re-election year as a new Bloomberg poll reveals key voters are more concerned about domestic issues, with 68% of respondents saying they approve of funding for border protection, a larger share than the 61% who back aid to Israel or the 58% who favor aid to Ukraine. Your team coverage starts right now with Bloomberg's Anne-Marie and Katie Lyons down in Washington, D.C. AMH laying the groundwork, Secretary Yellen, for President Xi Jinping and President Biden next week.
Yeah, Secretary Yellen made it clear, as she has done a number of speeches, Jonathan, that these economic tools, they will be used by the United States to protect national security. Now, her counterpart, He Feng, is talking about the fact that they want to make sure China and the United States get back on track when it comes to trade. Remember, the cloud over all of this for Xi Jinping, as he doesn't just sit down with the CEO of America, Inc., but he sits down with other top executives of American businesses. He's trying to make sure that China stays open for business because they are dealing with an economy domestically that has a tremendous amount of issues. But Secretary Yellen setting the stage. But Jonathan, the list of agenda items is going to swell when President Biden and Xi Jinping meet. First, they want to get their military contacts back on track in terms of those discussions. Remember, that was completely ripped apart when Nancy Pelosi went to Taiwan in August of 2022. They also want to bring up issues like human rights, fentanyl, and obviously the two power struggles we're seeing in the world right now, in Europe and in the Middle East.
This is important, arguably the most important relationship on the planet, yet Kelly Lyons, it is not the top concern for swing state voters in America. Just 1%, according to our poll, said U.S.-China relations were their most important issue.
Yeah, this Bloomberg Morning Consult poll reveals that voters in these 7 swing states are much more focused on domestic issues than the ones that they face abroad. As you said, John, the majority of them support more funding for the U.S.-Mexico border than they do for the conflicts in either Israel or Ukraine. And what also might be problematic for President Biden, who has tried to be the America's back president, go back to being a globalist nation rather than the isolationism that dominated under former President Trump. The majority of these swing state voters actually think they trust Donald Trump more to handle Ukraine and Israel than they do Biden. So that is problematic for a president. Of course, overall, in these 7 swing states, Trump leads Biden by 47% relative to Biden's 41%. This is problematic, assuming that this is the 2024 matchup. Right now, these are the presumptive Democratic and Republican nominees. Things could get a little bit more interesting, though, John, especially in light of the announcement yesterday. Senator, the Democrat from West Virginia, Joe Manchin, announcing he is not seeking re-election in 2024. And not only does that potentially disrupt the math in the Senate, mean it may be harder for Democrats to retain their very narrow majority in that chamber, it also could theoretically set him up to pursue the presidency himself or potentially the vice presidency. He, of course, is affiliated with No Labels, an organization that has said by early next year they will decide if it's looking likely to be a Trump-Biden rematch in 2024, whether or not they will run a unity ticket. They said yesterday in a statement in light of Manchin's announcement that they haven't made any decisions yet on if they will run a ticket or who will be on that ticket, but there's certainly been a buzz here in Washington in the last 24 hours, John.
AMH, just to pick up on that, if it's a Trump-Biden rematch, still an if at this point, what does the president do about these numbers in our poll this morning? They say they trust Donald Trump to navigate the Israel-Hamas war more than Biden, 44% to 31%. And preferred the former president more on the Russia-Ukraine war as well, by an 11-point margin.
These are challenging numbers for the White House. I mean, if you're the campaign, you're looking at these numbers, and Jonathan, this is our second set of results. And for the most part, they're in line with what we saw last month as well. These are the states where elections are won and lost. And Jonathan, they do not look good for this president. When you have a name like potentially Joe Manchin circling around, that would take votes from Joe Biden. One interesting part of this poll, and this is new to this month's poll, is we asked about RFK. And Jonathan, he's taking 10%. But with RFK, it's not just from Joe Biden. He's also taking from former President Trump. But what it does show, our poll, 10% from RFK and some others floating around, 19% of these swing state voters want someone else. They're called double haters. They don't like Trump and they don't like Biden.
Interesting. AMH, Katie, to the two of you, thank you. For the broader price action, we're about 23 minutes in. We're positive 0.5%. Let's get you some sector price action. Here's Abby.
Well, John, we're looking at a broad-based rally today. Most of the S&P 500 sectors are higher, supporting that gain. Tech up the most as yields are lower. Valuation looks more attractive. Energy the second best, up 0.7%. To the downside, we have consumer staples and healthcare. On the week, it's going to be right down to the close. Right now, the S&P 500 up about 0.2%. Most sectors are lower. In fact, at this point on the week, just two sectors are higher. Tech and communication services, not surprisingly, energy down 4%, with WTI crude, of course, back below $80 a barrel, even though higher today.
Abby, thank you. Up next on this program, your trading diary.
The younger generations are more, of course, pay more attention to sustainability, and so they are looking at brands that are greener. But you have to make sure you're authentic because they hate greenwashing. But what is very important to remember is that none of them, whether they're young or not, will ever sacrifice product quality and efficacy to sustainability, which is why part of the big transformation of our R&I, where there's this €1 billion we spend every year, most of it is spent on transforming our formulas from petrochemicals to biosourced ingredients and green sciences, but without losing the efficacy.
Here on the S&P, up by 0.5%. That's the price action this early Friday morning. Let's get to the trading diary. Things shaping up as follows. Secretary Yellen speaking at 3 p.m. Eastern. Then next Tuesday, more Fed speak from Goolsbee and Jefferson. Plus, we'll get US CPI. Wednesday, PPI figures. Plus, President Biden expected to meet with Chinese President Xi Jinping in San Francisco. Thursday, Macy's, Walmart, and the Gap report earnings. And Friday is the deadline for Congress to avoid a shutdown. That conversation is just around the corner. That does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Friday morning. Matt Miller here in the Interactive Broker Studio with Molly Smith. Paul Sweeney is on assignment.
Good morning.
He's actually down at Duke.
That's
watching
not,
basketball.
Oh, no. Oh, it's too soon to get
football.
into that. Don't say that.
But we say on assignment.
We say go Syracuse, too.
Ah, the oranges. Excellent. So we have University of Michigan consumer confidence readings out, and they're big. 1-year inflation expectations, 4.4%.
I'm scared. That was a big number. Highest since 2011.
Wow.
You saw that one coming?
Wow.
I'm
did
scared.
not see that coming.
I
All right,
didn't
well,
see
that's one more thing that Jerome Powell has to deal with besides just closing that door. Let's get over to John Tucker right now. He's got your Bloomberg Business Flash. JT?
And then the UMISH current conditions index, the sentiment index, that coming in lower than forecast at 60.4. And you also, the 5 to 10-year inflation expectations, that was 3.2%. So that was above the prior reading, also above expectations there. The go right to Treasuries. So earlier we were down 3 basis points on the more policy reactive 2-year. Right now it's unchanged, so we shave that off. Right now, 5.01% for the 2-year. Again, not what the Fed wants to see. But economist Ian Shepherdson at Pantheon Macroeconomics says, you know what, the inflation fight, as far as he's concerned, is won. And Fed Chair Powell was just being cautious when he delivered that hawkish message yesterday.
The remarks he made yesterday were kind of a slightly more amped up version of what he's been saying for a while, which is that, yeah, the recent data have been good, but they're not yet definitive. And I think they're very nervous about declaring victory and then having to undeclare victory.
Right now, the equity's coming in just a bit, still higher. S&P 500 up 0.3%, up 12 points. The Dow Jones Industrial Average 55 points higher. That's up 0.2%. The Nasdaq 100 up 93 points. That's a rise of 0.6%. And investors looking for signs of economic slowdown, they're taking it out, it seems, on the advertising industries this morning. You have that digital ad company, Trade Desk, tumbling right now. Those shares down about 20%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. Molly and Matt. Matt and Molly.
John.
M&M.
John.
Yes,
hey,
sir.
Do you have Apple CarPlay? Or
no,
Android Auto?
I feel like I shouldn't say no. But
Well, you can say
truth.
no. We're all about honesty.
But can you show me how to install it on my car free of charge?
No.
So
You have to buy a new car in order. You can't. Okay, so for
No, I have a
you,
car.
it's not free. For you have to buy a new car. But for everyone else who has Apple CarPlay and Android Auto, you can now get Bloomberg Business, that means Bloomberg Podcasts, live audio feeds, Bloomberg Radio, Bloomberg News Now in audio form in your dashboard because...
But I'm here live in the studio. I can hear it.
Well, you don't need it. You don't need it. But for everybody else, other than John Tucker, you can now get the Bloomberg Business app in your car, in your dashboard. It's free on Apple CarPlay, on Android Auto. You just have to download the app on whatever smartphone you have. I don't even think Tucker has a smartphone. He's still got a flip phone. He's still got his Nokia.
You got a dumb phone over there?
The Michael Douglas gigantic phone.
Big brick. If you happen to have a modern smartphone and a modern car, you can get the Bloomberg Business app. That was the main point I was trying to make.
How about that?
In your dashboard.
All right,
so that's
join us,
pretty awesome.
John. Rise.
All right, Nora Melinda joins us. She's a Wahoo.
I am Wahoo Wah.
Yeah, there you go. And she also writes about stocks for Bloomberg News. And what a fascinating market. I mean, yesterday was unbelievable, right? After the auction, and then Jerome Powell, and he kind of had an attitude and just drove yields up, stocks down, and now I guess we're getting a little bit of recovery.
And now we're bouncing back.
Yeah.
But looking at a few names this morning, Plug Power, that is Plug for that ticker that you're looking for, that stock is down as much as 40% today, which is its biggest drop since March 2014. It's also its lowest intraday level since April of 2020. But essentially, the company issued a going concern warning yesterday evening on the heels of a weak third quarter. This company is really known for making machines that produce hydrogen and use it as fuel. It essentially splits gas from water. And its services have really made it a bellwether in the industry, but it also carried along with it substantial costs. The company did say that its existing cash and available for sale and equity services will not be sufficient to fund its operations through the next 12 months. So
I feel like going concern is some pretty twisted jargon for we're about to go bankrupt. Because when you say going concern, you imagine the business is going to continue, right?
I think that where it gets a little lost is that the rest of that phrase is that, you know, there is a going concern about our ability to sustainably operate. As in, we are continually monitoring the situation.
Concern as in worry, not concern as in business. I was thinking going concern, like we are a going concern.
It's okay. Many people are confused by that.
Yeah, it tends to be more the negative reading, like you said, the precursor to bankruptcy typically. I mean, is that where people are possibly thinking?
I mean, I think that when companies like this do issue a going concern warning, it's raising a lot of alarm bells and it makes investors nervous. So as you can see, that stock is really plunging. But I did want to flip over to Trade Desk.
Yeah, tell us.
That's ticker TTD. That stock is down as much as 22% today for its most since May 2022. It's tumbling. It's an advertising tech company that's tumbling after giving a fourth quarter forecast that was weaker than expected for both revenue and adjusted EBITDA. We did have a KeyBank analyst, Justin Patterson, noting that this is more of a speed bump for the company rather than a structural issue. But still, him and a few other analysts have cut their price targets on the stock, noting that Trade Desk's weak guidance overshadowed an otherwise strong quarter. But I am watching peers. Our team is watching peers that are also tied to digital advertising like Roku, Pubmatic, Meta, Snapchat, Pinterest. But really interesting what's going on there.
Still up 36% year to date, Trade Desk.
Right, that's really good to point out.
One other stock that you're watching, I know, is Wynn Resorts. That's a stock that has done a whole lot of nothing year to date after this drop. What's going on there?
Yes, so Wynn Resorts, it's seeing its biggest plunge since October of 2022, down almost 10%, as much as 10%. It's plunging after the casino operator reported a third quarter Macau adjusted property EBITDA that missed expectations. The company did perform well in Las Vegas, but analysts are mostly focused on Macau, which we do know is located in China. Wynn Resorts is really known for having luxury resort experiences, but a Barclays analyst did say that the margins and commentary were very disappointing, while a Morgan Stanley analyst said from this point, Macau is relatively stable but needs more visitation to see an upside. So, are people heading over to Macau? I've never actually stayed at Wynn Resorts, but I'm curious if you all are, pretty familiar with the experience.
I'm not a gambler. I don't know.
I would have thought it'd be more likely you than me, so I'm going to say no.
I should. Well, here's the thing. I had a very bad experience with gambling when I was a young man.
Okay.
And thankfully, I've learned from that mistake. Same is true with credit cards. In college, I lost a lot of money gambling at one point. I haven't gambled since. In college, I ran up credit card debt at one point. Haven't used a credit card since.
Well, that's very fiscally
and I'm
responsible
old.
of you.
Very
that's
old.
Good. Don't say that.
That's good.
I turned 50 last weekend.
Oh, congratulations.
Thank you.
Happy belated.
Thank you. Thank you.
Wow, what a milestone.
All right, Nora Melinda, thanks very much for that. Nora Melinda covers stocks for us from Bloomberg News and is a UVA Wahoo. I don't know why. I just find it interesting, these schools that don't seem to have real mascots in a sense, right? I mean, I guess you're the Cavaliers officially.
Yes, the Cav man.
But the orange Syracuse, you're just like, that's from William and Mary, right?
Is it? I don't even
I
know
think
that
it's
backstory.
William and Mary of Orange, right? Isn't that
the more you know.
John Tucker?
Why would it be?
I don't know. Maybe the university was started by whatever religion those guys were. I mean, otherwise, what is an orangeman? Otherwise, which is what it used to be
gender neutral.
Before they went gender neutral, right? But
is it still the Carrier Dome?
Well, actually, no. It's now the J.D. Power Dome, I believe.
Oh, because Carrier Air
have
Conditioning moved out of Syracuse to Connecticut.
So the mascot is gender neutral, but you're still backed by a big evil corporation.
Hey, now we are a little fuzzy orange fruit, just trying to do some good in the world.
I love it.
All right, let's get over to Washington D.C. right now. A lot going on there as the government, as Congress, runs closer and closer to a shutdown. We have a serious upset, I would say, for Democrats in West Virginia. Nathan Dean joins us. He covers all things politics out of the Washington, D.C. Bureau. So Mr. Manchin is not running for re-election. What does this mean for the Senate, Nathan?
Well, it means pretty much the Democrats have a really steep uphill battle to keep the Senate in the 2024 elections. Look, it was going to be a challenge to begin with, but with Senator Manchin announcing his retirement, that essentially flips the state to the Republicans. And so, this election is very bad for those members in the Senate. There aren't many Republicans out there running for re-election that the Democrats could potentially have a chance. And that actually could play into what the Democrats do for the rest of the year before the election. We may see them focus more on confirming judges and confirming appointments and trying to get a lot of the cleanup work that they can do when you control the Senate before, they anticipate to lose it in the 2024 election.
I wanted to ask you about that, Nathan, because I think, a lot of us know Joe Manchin to be, I guess, a moderate Democrat is how he would describe himself. And on a lot of issues, probably leans a little bit more right than left. And would have thought maybe, if the Democrats could hold on to that seat, that this would maybe be viewed more opportunistically, perhaps, if you could get somebody who's like a little bit more in line with the agenda that you're trying to push.
Yeah, but I mean, you also have to answer the question of what would he do if he were to actually win re-election? I mean, then, the makeup of the Senate could be if the Republicans were to take the Senate with Senator Manchin there, he would lose a lot of that power as being that one kingmaker individual that can sort of go back and forth between the parties and try and appeal. So I think this is sort of also maybe, and this is just my own view, that maybe this is Senator Manchin trying to prepare for the future. He made that statement yesterday online how he wants to travel the country and see if there's a way to mobilize a centrist third-party run. I don't think that's going to happen. Again, that's just my own personal view. So I just think that he saw the future and was like, you know what, maybe the future is better for me working outside of Congress than being inside, because if the Republicans do take the Senate, he may actually not have all that much stuff to do.
All right, let's talk about the Congress here. Mike Johnson has, 7 days left before a government shutdown. Does he have any plan to stop that?
So, what we've just heard is, there's really two options on the table. One is a clean continuing resolution. This other idea, and this is the one that I think he's going to go with initially, is this idea of a laddered continuing resolution, so that he would extend funding for certain agencies to, say, January 15th, and then funding for other agencies to February 15th. So then you would have a rolling set of potential government shutdowns, depending on which agency you're impacted by. We are actually telling our clients that we still think it's around a 40% chance of a shutdown next week. I know that doesn't sound like in line with the news headlines that are coming out there, but there are just too many political cakes that are being baked around. Ukraine, Israel, House GOP ideas, border security, and none of these ideas are actually close to fruition, and they need